Welcome to Paycheck for Life, Acera's new and mid-career employee webinar. In this webinar, we are assuming that you're either new or you're in the middle of your career, which is why we called it New and Mid-Career Employee Webinar. But the bottom line there is that you're not yet near retirement, which in this case is a good thing because it means that you still have plenty of time to plan for your retirement. So I'm going to tell you in this webinar everything that you might want to know about doing that retirement planning so that you can enjoy your retirement when the time comes. And perhaps you can retire a little bit earlier than you thought. And since you're curious about retirement planning, to watch this, you probably have some questions. Questions like, what do I need to know about my pension? Do I need to do anything? And if so, what do I need to do? Well, I kind of already know 95% of the questions you're going to ask because I've been doing this a long time. And so what I've done is arrange the answers to what I think you're going to ask into the form of this checklist. But if you have additional questions, of course, feel free to ask those as we go along. So here are the topics that we're going to go through in this webinar. I'm going to help you understand a few retirement basics. I'm going to help you understand some pension math. There's very little. It's just one single multiplication formula. That's our retirement formula. And then I'll talk about purchasing extra service credit to increase your pension when you retire. I'll show you how to get a precision pension estimate using our member portal on our website. And I'll help you understand retirement eligibility, which means that at some point you are going to become eligible to retire. And you're going to need to meet some requirements to do that, and I'll show you what those are. I will help you understand some additional benefits that we offer, including healthcare benefits, death benefits, and I will help you designate your beneficiary or beneficiaries for our death benefits. Okay, then we're going to talk about career planning options. And what I mean by career planning options is that at some point in the future, you're going to stop working for your employer that you're working at that gives you a Acera membership. And so what are your options regarding Acera? And then I will help you make a retirement planning picture. And what I mean by that is that we're going to take a little peek into the future and look at your possible retirement income after your retirement now so that we can see if you need to make any adjustments to it before you get there. And then as part of that discussion, we'll talk about starting a 457B account. Okay, so let's jump right in. Let me help you understand some retirement basics. First of all, who is Acera? Well, in one sense, Acera is this acronym, the Alameda County Employees Retirement Association. But Acera is made up of a lot of people. There's 93 of us that work at Acera. We're all Alameda County employees. And our entire job, the only thing that we do, is we provide retirement, disability, and death benefits to our members. That's you. So you are also members, you're also part of the Who is Acera because you're a member of Acera. And you're a member of Acera because of the position that you work in and who you work for. So at some point you worked full time or you still work full time in a retirement eligible position for one of the 6 participating employers in Acera. These are the 6 public agencies in Alameda County that use Acera to provide retirement benefits to their employees. So if you work in one of these places in that full-time retirement eligible position, even if at some point in the future you go less than full-time, you automatically became an Acera member as soon as you entered that retirement eligible position. And in fact, it's mandatory. It's automatic and mandatory. And as an Acera member, you pay into Acera's fund with every paycheck. So every time you get paid, if you look at your pay stub, you'll see a line in the before tax deductions column that says something like retirement, and you'll see some money coming out of your paycheck. And I recommend going ahead and looking at that just to verify that that's happening. And that is the money that's coming out of your paycheck, and it's going into Acera's fund every time you get paid. And then also, every time that happens, your employer makes a contribution on your behalf. So you are both, you and your employer are paying into Acera's fund every time you get paid. Now, we don't want that money to just sit around and collect dust, so we invest it in a wide array of investments all over the world with the goal of earning interest. So not only beating inflation, but earning additional interest. It's these 3 sources of income that give us this large pool of money that we call a Sarah's fund. The fact that you're paying in, your employer is paying in, and we're earning interest on those contributions. So why are we collecting all this money? What are we going to do with it in the future? Okay. So here's where you and your career come in. So you work in your full-time eligible position, and throughout your career, throughout your membership with the Sarah, the entire time, you're earning more and more and more credit toward retirement. And you're earning credit toward retirement in three different categories, which I'll talk about when I show you the retirement formula. Okay. And essentially, the longer you work, the more credit you earn toward retirement, the larger your payment is going to be when you retire. Because at some point in the future, right about here, you're going to stop working at your job and you're going to stop earning credit toward retirement and you're going to start collecting the retirement that you earned throughout your career in the form of a monthly retirement allowance for life. And you're going to get that retirement allowance every month, each and every month for the rest of your life. You cannot outlive your Acera retirement. It's amazing. It Acera is a what's called a defined benefit pension plan, and these are special. And the reason that they're special, first of all, is because first, the idea of a defined benefit means that your benefit, your retirement allowance, that monthly retirement allowance is defined by a formula, which I'll show you, which means that you can know what the formula is in advance and you can get very precise estimates of what your monthly retirement allowance will be after you retire. You can get those estimates throughout your career. You can plan very precisely for your retirement income after retirement. That's one way that it's special. The other, and it happens um, every month for the rest of your life, so it's guaranteed. It's guaranteed income that you can plan on and count on for the rest of your life. And the other way that it's special is that regarding your employee contributions, everything that you pay into Acera throughout your entire career, plus all of the interest that you earn because we pay interest into your employee contribution account every time the fund earns interest, we give you all that money back within your first 3 to 5 retired years through those monthly payments. So you get all that money back that you paid in, and then everything after that, it's almost like it's this amazing bonus that you get for participating in a defined benefit pension plan. So you're retired for 3 to 5 years, and then maybe you're retired after that. You live another 15, 20, 25, 30, 35, 40 years, and you're going to still get that monthly payment every month for the rest of your life, even though we've already given you all your employee contributions back. And that's because the employer contributions pay for some of it, but mostly it's the investment earnings that pay for 75% of your lifetime pension. Okay. And one thing that I want to mention here, just to go back one slide, this term retirement allowance. I'm throwing around some terms here, some pension lingo. Retirement allowance, pension benefit, pension allowance, retirement benefit. These are all synonyms. They all mean the exact same thing, which is this guaranteed monthly payment for life that you will receive once you retire from Acera. Okay, so that's the basics. That's, basically how Acera works. Now, to provide some context for some of the more detailed discussions we're about to have, let me show you this pension milestone chart. These are some of the milestones. Probably, I don't know that there's any, there may be a couple more that we'll add as we go along through the presentation. But these are some of the milestones that you'll see throughout your membership with Acera. So you have, first off, your date of hire. This is your first day of work in that full-time retirement eligible position. Then for 4 of our 6 employers, 2 weeks goes by, and the first day of your second pay period is your date of entry into Acera. This is your first day of Acera membership. This is the day that you start earning credit toward retirement. Now, if you work for Livermore Area Recreation and Park District or the Housing Authority, there's no 2-week lag time. Your date of hire in that full-time retirement eligible position is your first day of Acera membership. Okay, then what happens? Well, you start in your membership with Acera, you're working your job, you start earning credit toward retirement, and one of the 3 categories is called service credit, and that's just basically time worked. So you work full-time for 5 years, or the equivalent of full-time for 5 years, and once you achieve 5 years of service credit with Acera, you're considered vested in the pension system, vested in Acera. Vesting is kind of a loose term. It sort of means guaranteed. Okay, so once you achieve that 5 years of service credit, you start being able to unlock and some of the guaranteed benefits, okay, some of the vested benefits. But that's kind of what it means, okay? So that's at the 5 year mark. Okay, then there's some indeterminate amount of time where you become eligible to retire is the next milestone. And it's based on some combination of your years of service credit and your age. And there's a few different combinations that will get you there. I'll show you what they are a little bit later. But this is the first day that you can physically retire if you chose to. Now, many people do not retire on this day. Many people will continue to work past their first date of retirement eligibility to earn more and more credit toward retirement to maximize that monthly retirement allowance, to dial in their retirement allowance, essentially dial in their paycheck for life to what they need to be able to afford their life in retirement. Okay, so then the next milestone is your last day of work. This is your last day on payroll at your employer, also known as your termination date. This is the day that you stop earning credit toward retirement. But you'll notice that if you ever log into your account on our website and look at your amount of service credit, you'll see that there are a lot of decimal places after it. If you've worked here for, let's say, seven plus years, you'll see like it'll say like 7.84125. And all those decimal places are us calculating your service credit down to the fraction of a day. So you're going to earn service credit all the way up into the last 15 minutes of your termination date. And you get all those decimal places. You get credit for all those fractions of a day in the retirement formula. And I'll show you that in a few minutes. Okay, the next milestone on the pension milestone chart is your retirement date. This is a date that you choose. You tell us when you're ready to retire. And this is the day that you start collecting the retirement that you earned in the form of that monthly retirement allowance for the rest of your life, up until your death. That is when your retirement payments stop. Now, there's one more milestone on the chart, and that is because at the time of retirement, you have the opportunity to choose a beneficiary. A beneficiary is somebody who gets your death benefits. And you get the opportunity to choose somebody to receive a continuance, which is a continuing monthly payment after your death. And in most cases, it lasts for the rest of your beneficiary's life. And so upon your beneficiary's death, that would conclude us paying out the benefits that we owe to you and your family that you have earned by working in your retirement eligible position for the residents of Alameda County. A couple more points I want to make about vesting. The guarantee, the vesting, I said vesting kind of means guaranteed. The guarantee is guaranteed by state law. So this is a state law, the 1937 Act. This governs everything that we do at Acera. It tells us how to calculate all the retirement payments. It tells us how to collect the contributions. It tells us how to do everything, and it guarantees your lifetime pension payment. And the guaranteed benefits are that monthly retirement benefit, that retirement allowance for the rest of your life, an annual cost of living adjustment, which is a percentage increase each year in retirement to your retirement allowance, and a $1,000 lump sum death benefit. There are also additional benefits depending on the different, which option. There's different options you're given at the time of retirement. You don't need to know those now, but there are additional death benefits available to your beneficiaries, including that continuance payment that I already mentioned. Okay, let me tell you about your tier. This is kind of important. The difference between the tiers is there's a few differences in how we calculate things depending on which tier you're in. So you're all in one of these tiers. And okay, so to figure this out, to figure out which timeline to look at, first of all, if you're a safety member, you look at the bottom timeline. Safety members are sheriff's deputies and probation officers, and there could be some other sworn officers that I'm not aware of. Now, if you're not a safety member, then you're a general member. So general members would look at this top timeline. Unless you're a general member who works for the Housing Authority or a general member who works for Livermore Area Recreation and Park District, and then you're looking at the timeline for your employer. So the way this works is you enter the specific Acera tier if you enter before the cutoff date for the tier. So if you entered as a general member before July 1st, 1983, that would have put you in tier 1. Now this is a new employee mid-career webinar. Probably no one's in tier 1 here because that was a long time ago. But if you entered Acera July 1st, 1983, all the way up to December 31st, 2012, that would have put you in tier 2. And if you entered Acera January 1st, 2013 and beyond, that would put you in tier 4. And that is the case with all of the different timelines. Now you'll notice that the Housing Authority has a different Tier 1 cutoff. LARPD has a Tier 3. They don't have a Tier 2. That's something that they negotiated for their employees, and they have a different Tier 1 cutoff. And the safety members have three Tier 2s. So if you're a safety member, the Tier 2 depends on when you entered, and then if you entered during this period, you had a choice between Tier 2C and Tier 2D um, within your first 45 days of your safety membership. If you didn't make the choice, you were defaulted into one of the tiers. Okay, now for everyone, if you don't remember your ACERA date of entry, don't worry. We know what it is. We keep track of that for you. And in fact, if you log into your account on our website, you can see what your date of entry is, and in fact, it will just go ahead and tell you what your tier is in there, along with a lot of your other pension data that we have for you. And let me just show you where to do that. This is our website, acera.org. And on any page, you just go up here, you click the login button, and it takes you over to our member portal, known as Member Direct. Okay, now if you've already logged in here before, you just put in your username and password. If you've never done it, you're gonna have to enroll. So you're gonna have to click the enroll button. And if to enroll, you're gonna need an enrollment pin. Okay, now we sent everybody a pin in the mail back in November, all the active members. You're all active members if you're actively working for one of our 6 employers. Um, and for all the active members, we sent the enrollment pin back in November, but it expired within 90 days. So if you didn't take advantage of it, you can request a new one by clicking this link, fill out the data here, hit request pin. But what we do is our staff gets it, my colleagues, they print out the letter, they send it to you in the mail. So it will take a few days to receive it. You won't be able to get in there instantaneously. That's just for extra security. But once you do get in there, you come back to the enrollment page, put your pin in, the rest of your info, uh, create username and password, security questions, and then you can get right in. And then you'll see your pension data in there. Okay, so going back to including your tier, which is what we were talking about. So that's how your tier works. And if you want more info about your tier, because especially if you have reciprocity, and I'll talk about reciprocity in the second half of the presentation, but that's when you link different retirement systems together in the state of California, California retirement systems, to synergize different aspects of the pension systems together. If you have an earlier date of entry into another pension system that you've linked with Acera, that could put you in an earlier tier, and there is information about that over on the tier page at acera.org/tier, T-I-E-R. Okay, so I'm going to show you this slide right now, and the reason I want to do this is now that we've kind of gotten some of the basics of the pension membership and tier and contributions and stuff out of the way. Probably the main reason that you're here is you're curious about all of those bullet points I put in the advertisement about retirement planning. And so what I want to do is help you get a good understanding of that in this webinar early now, because you're a new employee or you're in the middle of your career, because like I was saying earlier, you have time to plan for this, which is great. So what you're seeing here is a representation of looking into the future and thinking about your income once you retire from your job. Because when you stop working your job, you're going to stop getting your paychecks. You're going to need money to pay for your life in retirement. And the money that you're going to receive, your retirement income, is going to come from three broad categories. One is your Acera monthly pension that you're earning and you're going to get to collect in the future. You can kind of lump in any other pensions that you have into this same category. The second category is Social Security. If you pay into the Social Security system, which is the federal government's sort of pension kind of annuity system, it's kind of their retirement payment system in the U.S. You will get to collect Social Security in the future if you pay into Social Security for at least 10 years and what they call 40 quarters, so 40 quarters of a year. And you'll get to collect something for Social Security. So that's another source of income. The third broad category is, if that's not your pension or Social Security, is any additional savings and investments that you make throughout your lifetime. And so what financial planners will tell you is that when you go to retire, your retirement income needs to be at least 80% of your working salary in order to maintain your standard of living. This is called income replacement. You need to achieve at least 80% income replacement to maintain your standard of living. Okay, so that may, to some of you, this is the type of statement that for me sounds stressful. So it might sound stressful to some of you. Some of you might be like, "Yeah, it's fine. I got this." But I think by the end, you will all kind of you'll see how easy this is. We'll use some technology to get these estimates. I'll show you how to get a pension estimate, Social Security estimate, and then I'll show you how to figure out if there's a gap and if you need to save additional through technology. And it's actually pretty easy, so I wouldn't stress out about it. But the reason I'm showing this to you now is to give you some context for this discussion. I'm going to tell you a lot about the Acera monthly pension, and then we'll get back to this slide, and I'll tell you how to do that planning to get a Social Security projection and to figure out if there's a gap in your future income and whether you need to start saving more now and how to save and where to save that money. Okay. So we'll return to this idea. So let's dive into a little bit deeper into Acera, and I'll help you understand some pension math is the next section of this presentation. And the reason I'm doing this, okay, you might, if especially if you're brand new. I know some people, the timing is like you get the email I send out, you've only been here a few weeks, and you're like, oh man, do I need to know this right now? My retirement is 20, 30 years away, 40 years away, whatever. The reason I want you to understand this right now is because this will help you do that retirement planning. This will help you maximize the monthly retirement allowance if you understand this formula. And it's actually very simple. I'll walk you through it right now. Okay. This is the retirement formula that Acera is going to use to calculate your monthly retirement allowance for life when you go to retire. And when I said before that throughout your career, you're earning credit toward retirement in three categories, these are the three categories in the formula, okay? The age factor percentage, I'll show you what that means in just a second, but essentially the older you are when you retire, the higher this age factor percentage is going to be. And so the way that you earn credit in that category is simply by getting older. That one's kind of a cheap, way to explanation of how to earn credit in a category, but it's just one way to think about it. You don't really have to do anything with that. You just age naturally. So that one's easy. Service credit, this is this is basically time worked. Time worked at your job, and you earn more and more service credit toward retirement. It's measured in years. The more service credit you have, the higher your retirement allowance. And this one here, the highest average monthly salary. We do a calculation. I'll show you what it is in a few minutes. We do a calculation to determine your highest rate, your highest average monthly salary in your career when you go to retire. So the way that you maximize your retirement allowance in this category is through achieving higher and higher salary amounts throughout your career, through cost of living increases, through raises, um, perhaps promotions, and even perhaps changing jobs so that you can get into a higher salary range. And I'll talk about that, especially in terms of, one way to change jobs is to go to a different pension system. And so you can do that by establishing reciprocity with a different pension system. So that's one way to achieve a higher salary. And what this equation is telling is showing you is, okay, let me start over. What this sentence is telling you at the top of the slide is what this equation is doing. Okay, so you see it's a simple multiplication. Okay, so in retirement, you are going to get a percentage of your highest salary for each year of service. And I think if I plug some numbers into the formula, I think it will help you get a better understanding of what exactly this is doing, how it's calculating your retirement allowance. Okay. So you're going to get 8% of your highest salary for each year of service in retirement. Let's say, for example, that the percentage of your highest salary that you are going to get for each year of service when you retire is 2%. And let's also say, to continue the example, that you worked by the time that you retire for exactly 20 years. So we'll plug 20 years in here. Okay. Now, what this means is that you are going to get 2% of your highest salary for each individual one of those 20 years of service that you worked. Okay. So if we take the 2% and we add them all up, we line up 22%. Okay. 2% plus 2% plus 2% 20 times. That equals 40%. Essentially, we're multiplying these two together. 2% times 20 years is 40%. Okay. So that means The percent of your highest average monthly salary that is going to become your retirement allowance is 40%. So just to finish out the example, let's say your highest average monthly salary before you retire that you are earning while you're working is $5,000 per month. Well, 40% of $5,000, when we multiply them together, would be $2,000. So this would become your retirement allowance from a Sarah that you would get for the rest of your life. The $2,000 is 40% of the $5,000 salary. You're achieving 40% income replacement in this example. So you can see, because it's a multiplication, the larger any of the three factors in the multiplication are, the higher the age factor percentage, the higher the years of service credit, the higher the highest average monthly salary equals a higher monthly retirement allowance. So the way that you dial in your highest monthly retirement allowance is by dialing in each of these three factors. And I'll show you how we calculate each one of them so that you can understand how to maximize each one. Let me start with the age factor percentage. That one's easy. And like I said, it's that one you don't, you just kind of naturally age. But let me just show you how it works anyway. Okay. So what percentage of your highest salary in your case will you get for each year of service? Because it's not going to necessarily be 2%. It might be a different percentage, and it's going to be based on the tier that you're in. This is one of the places that the tier comes in to play. Okay. So what you're seeing here is a sample of some of the sets of age factors that we use for the formula. And what you do is you find the column that has your tier. So if you're a safety member, you're going to look for your tier over here. If you're a general member, you look for your tier over here. Let's say you're a general member in tier 4. So you're going to just look at this column, forget about all the other columns, they don't apply to you. Okay. Let's say that when you go to retire in the future, you're a general tier 4 member and you're age 60. Well, we see where those intersect. Tier 4, age 60, 1.80%. That is the percentage we would stick in the formula for you. You would receive 1.80% of your highest salary for each year of service if you retired at age 60 in tier 4. You'll note that I was saying earlier, the older you are, the higher the percentage. You'll notice that happening in the chart. The older you are when you retire, the higher and the higher percentage you get. So that's the way that you kind of earn credit in this category, is just by retiring at an older age. And you'll also note that for each one of the tiers, there's a maximum percentage that you can receive where it maxes out. And if you retire at that age or older, you just get whatever the maximum is for your tier. So if you retired in tier 4 at age 68, you still get the 2.50%. And that goes for 69 or 70, 71, etc. The last thing that I want to mention about this chart before I move on is that you may notice that I skipped a bunch of the ages here. That's because they don't all fit on the chart, because there's an incremental increase with every quarter year that you age. So if this were the full chart, it would say like 52, 52 and a quarter, 52 and a half, 52 and 3/4, 53, and so on and so forth. And there's a slight incremental increase for each one of those quarter years that you age, and it's based on your birthday. If your birthday is January 15th, April 15th would be 1/4. So you just keep adding 3 months, and every time you pass one of those dates, you go up one notch in this age factor chart. And if you ever want to see the full chart, it's out on our website. Okay, so that's a lot of information to throw at new and mid-career employees. If you don't want to remember any of that, it's totally fine. I get it. Just remember this bottom line. Older retirement age equals higher age factor percentage up to the maximum for your tier. So that's how the age factor percentages work. Let me tell you about the service credit. This one you have, yeah, this is the one where you kind of have the most options to dial in this monthly retirement allowance. Okay, so regarding service credit, how do you earn service credit? While you work your job. While you work your job, you earn service credit. You start earning service credit when you enter a SARA on your date of entry, and you're going to earn service credit all the way up until your termination date from your job. And like I was saying earlier, we calculate it down to the fraction of a day, and it's measured in years. You earn service credit during your regular work hours. That makes sense. But you also earn service credit during your earned leave times. So these don't count against you for the purposes of earning service credit toward retirement. So when you go out on your earned vacation or earned sick leave, if you get management leave or comp time, or your holidays or floating holidays, and you mark those on your timesheet, you earn service credit during that time. So it's pretty great. Now, you do not earn service credit whenever you go out on leave without pay. If you're not receiving a paycheck from your employer, you're not earning service credit. Okay. Also, next category, purchased vacation. This is an option that some of our employers allow. If you don't, if you want to purchase additional vacation on top of your earned vacation, like let's say you earn 2 weeks a year and you want to purchase an additional week, they'll let you do that and you can take a 3 week vacation. But whenever you mark that purchased vacation time on your timesheet, you're not earning a Sarah service credit during that time. So that's just something to keep in mind. Okay, sold vacation. This is a different concept. This is where you take your earned vacation and you sell it back to your employer. Some of our employers allow this for cash. And you don't go out on vacation, you're just getting cash by selling your vacation back to them. And that's sold vacation. You don't earn service credit for that. And you also do not earn service credit for overtime, on call time, and standby time. Okay, now, one of the ways to dial in the service credit is by working longer. That one makes sense. You work longer, you earn more service credit. And the second way is if you have one of the types of time on this list, you can purchase additional credit toward retirement. So you basically give a Sarah money to purchase this extra time if it falls into one of these categories. You'll note that there's not just what they call airtime, which is just extra time. That's not on here. That is disallowed by state law. Okay. But if you have time that falls into one of these categories, you can make a service credit purchase. And the idea with most of these is that it's kind of a type of time where the law did not allow for you to earn service credit while you were incurring that time, but it does allow for you to go back later and purchase that time. The first category is the subheading or kind of the heading of this is ineligible non-covered service purchase. The idea here is that you may have done some work for one of our 6 participating employers prior to achieving your full-time retirement eligible position. And if it falls into one of these categories, known part-time, tap time, seasonal, intermittent, services needed, project, per diem. TAP is the county's temporary assignment pool. That's kind of like their in-house temp agency. If it falls into one of those categories, it's purchasable time once you achieve that full-time retirement eligible position. You'll notice that what is not on here is temporary, outside temporary agency or employment agency time. That does not count. Also, contract work does not count. So those are not purchasable. Okay, the next bullet point is the 2 week lag time between the hire date and the entry date. That's purchasable. Unpaid medical leave that you go out on during your active employment with your employer. So this is where you go out on unpaid leave. It's medical leave for your own medical condition, not a family member's condition. Once you return from that leave, you can buy up to 1 year per instance of time of that unpaid medical leave time. And returning to work simply means getting one paycheck for your employer from your employer. Also, state disability insurance leave, if you go out on that, you can buy that time as a Sarah service credit when you return from that. Military leave during membership. This is where you're actively employed by your employer. You go out on unpaid leave that is military leave. Um, and once you return from that leave, you can buy that time. So what this does not mean is prior military service, unless it was done before, I think like 1971. Probably nobody in here has that. Um, and so this is military leave during membership that you can buy upon return. And then somebody's asking the unpaid medical leave up to 1 year, does maternity leave count? Absolutely, it counts. It's probably the most common one is maternity leave up to 1 year per instance. So you could be out for a year, you can come back for 1 week, get one paycheck, go out for another year, come back to work. You can buy both of those periods, those 1 year periods. Now you'll notice I said for your own medical condition. That means that paternity leave for your partner's leave for having a child is not purchasable. And that is not our rule. That is because there's a code section in state law that would allow for that, but Alameda County has not adopted that. So that would be something that the Board of Supervisors would need to adopt. Okay, the next 2 bullet points here are both called redeposits. The first one is a redeposit of a prior membership. And I do see the question about rolling over into a Sarah, and I'll get to that in just a minute. Okay, so don't worry about Don't worry, I'm gonna get to that question. Okay, the redeposit of a prior membership. This is where you used to be an Acera member in the past. Like sometime in the past, you worked for one of our six participating employers. You were earning service credit, you were paying into the system, and you quit. And when you did that, you took a refund of your contribution account, which means that you canceled your Acera membership, you lost all your service credit. Then you come back later, you're working here again, you can redeposit an equivalent amount of money plus interest, which I'll talk about in just a second. And that is called a redeposit of a prior membership, and you would get your original service credit back from that previous membership. Additionally, one more thing I want to point out about this, and this is kind of an aside regarding tier. If you used to be an Acera member in the past and you return to your same employer now, we will put you back in your original tier. And there's more info about that if you go to acera.org/tier. There's some info at the bottom about getting back into a prior tier that you were in. Okay, and then the second redeposit of community property. Okay, this is where you are married or you are in a state registered domestic partnership, and while in that relationship, you are an Acera member and you're earning credit toward retirement. Well, if you divorce or dissolve that state registered domestic partnership, any Acera retirement that you earned while were in that relationship is considered community property, and that is one of the things that could possibly get divided out between spouses, ex-spouses or ex-partners, when that relationship is dissolved. So it depends on how you negotiate it. Some people are able to negotiate different parts of the community property away and keep their Acera um, membership whole. So that's if you're able to do that, you can do that. That's your thing that you would want to, work with your attorney on when they're dividing community property and you're working out the settlement. But sometimes what will happen is the ex-spouse will take part of your Acera account. They take part of your account, which means that they'll take a part of your service credit and a proportionate amount of your employee contributions with them into their own separate account. So then they have their own account. Now, if they do that and they decide to take a refund of their account, so we give them all the cash, we will let you know. We'll send you a letter in the mail telling you that they did that, and we will give you the opportunity to redeposit an equivalent amount of money to get back an equivalent amount of service credit that they took with them. And it's called a redeposit of community property. The final category is other California prior public service. This is where you used to work for another public agency in California, and you're not eligible for their pension. Usually for two reasons. One, you did not work there for long enough to achieve vesting or achieve retirement eligibility, whatever their rules are. Everyone has different rules, but whatever their rules are, you didn't earn enough time or enough credit to collect a pension from them eventually. The second reason that you might not be eligible to collect from that pension system is because when you left that system, you took a refund of your contribution account and canceled your membership over there. In either case, if you do have that type of time with another pension system and you need to take a refund from the pension system, we will allow you to buy that time as a Acera service credit. So it becomes a Acera service credit. So for example, let's say you worked for East Bay Mud for 1 year. You stopped working there. Okay. You can buy that year as a Acera service credit. All we would do is tell you you need to take a refund from their pension system. Now, separate example, let's say you worked for East Bay Med for 10 years. Now, I don't know what their rules are over there, but my guess is that 10 years would probably get you a pension out of whatever fund they use. I'm not sure what they use. You would want to check with them. Okay. Make sure, figure out the rules. If you're eligible for a pension over at the other pension system, probably it's going to be more financially advantageous for you. You can run the numbers yourself. They'll give you an estimate, just like we will. It'll probably be more financially advantageous for you to wait until you're eligible to collect their pension and go ahead and retire from that pension. So in that case, if you are eligible, you probably don't want to do this because it's rather expensive. But if you're not eligible for the other pension, then you are going to want to at least ask us what the cost is to buy that time. And I'll show you how to do that in just a minute. So these are the categories. If you don't see the type of time on this list, you can't buy the time. And there's more information at acera.org/service. Now, the times that are not eligible for purchase, I already mentioned the vacation purchase time, not eligible. You don't earn service credit for it while you're out on the purchase vacation. You can't buy it back later. Now, if you do this here or there throughout your career, I wouldn't sweat it. Like you get to take a vacation, an extra week of vacation for your mental health. And over a long career, purchasing a week of vacation here or there is not going to have a big impact on your final retirement allowance. So I would not stress out about that. And you can run the numbers on that yourself using our calculator on our member portal. Okay, non-medical leave without pay, not purchasable. Contractor temporary agency time, I already mentioned that's not purchasable, and I already mentioned that the other prior public service, while you still have contributions on deposit with that pension system, not purchasable until you take a refund of your money with that agency. Okay, so how much does it cost to make a service credit purchase? Oh, and you know what? One more thing that I want to say. I spent a lot of time giving you the details of all these. Maybe you don't have any of these types of time right now. Maybe you don't there you don't have any of this time. But it's good to know that these exist. It's good to know what these are, and it's good to know about the concept of purchasing service credit because maybe in the future you do incur one of these types of time, and then you'll remember, oh, I didn't earn service credit for that, but I can buy the time and come back and buy the time. And in fact, the sooner you purchase service credit, the cheaper it gets. And this is why. How much it's going to cost for you to make a service credit purchase is whatever your employee contributions had been had you worked the time. So, for example, let's say that you had 3 months of unpaid medical leave, and you want to buy that time. Okay, so you return from the unpaid medical leave for your condition, for your medical condition. You want to buy that 3 months worth of time because you didn't earn service credit for it during that 3 months because you were out on unpaid medical leave. Well, had you been here working your job during that 3 months, you would have been receiving a paycheck. And with that paycheck, Sarah would have taken money out of your paycheck in the form of your employee contributions. So whatever that dollar amount would have been had you worked the time, based on your own contribution rate, that is what it would become to make that service credit purchase. So if you have a type, especially like unpaid medical leave, if you look at your pay stubs right around that time, you can kind of get a ballpark of what it's going to cost you because you just multiply whatever your rate of contributions was over all the pay periods that you were out on unpaid medical leave. Okay, now it's whatever you would have had to contribute to a Sarah had you worked the time plus the interest that money would have earned between then and now. And that's because if we would have collected the money, we would have invested it. And we tend to earn interest. Sometimes in the short, we have 2 6-month interest periods per year. Sometimes in the short term, the market tanks, we don't earn interest that term, but then we usually make it back up later. So, and we have all our historical interest rates posted out on our website. So every time the longer you wait to purchase service credit, the more expensive it gets. Okay, let me give you an example of that. 3 months of unpaid medical leave. Let's say it was 5 years ago that a time you're trying to buy from 5 years ago. Well, 5 years ago, 10 individual 6-month interest periods have passed since then. So that's 10 individual points of interest that increase the amount of employee contribution, that increase that we add to the employee contributions. And so you have to pay the total, the employee contribution cost that it would have been plus the interest that money would have earned between then and now. If you do want to see our historical interest rates, all you do is go out to the web, go to sarah.org, go to your browser, sarah.org/interest. It's a shortcut, and it takes you to this chart, and it shows you how much we've made in every 6-month period, going all the way back to 1993. And so you can see how much we tend to earn, and you can see if you want to, do the math yourself, you can figure out how much interest that you're going to have to pay for making the service credit purchase. But you don't have to figure it out on your own if you don't want. We'll do it for you. And the way to figure out how much it is, if you don't want to do any math, very easy. You fill out our purchase request form at acera.org/forms. Going back to the website, you go under forms and publications, forms, scroll down to purchase request form right here. You got PDF and DocuSign options. I recommend DocuSign. You do it all online. Click the button, fill out your information, hit submit. You don't have to print out anything. And on the form, you are basically telling us some details about the time that you're trying to buy. You submit it to us. We'll do the calculations. We'll tell you, we'll make sure that it is purchasable, and we'll send you a letter in the mail telling you how much it's going to cost, and give you different payment options. And at that point, you can decide if you want to make the service credit purchase. Just because we do the calculation, you're not under no obligation to make the purchase. But at that point, you can decide if you want to do it and or how much that you want to purchase. So let me go back to this list real fast just to give you an example. All of these types of time, except for the redeposits, you could just purchase a portion of the time if that's all you want to do. The redeposits are all or none. And one more thing I'll say about costs is that all of these ones up here, you're paying the employee contribution only, so these are a lot cheaper than this one. The other prior public service, the employer was somebody else, so you're gonna have to pay the employee and the employer contribution. This one costs probably 3 times what these ones cost, so that one can be rather expensive. But you can decide if you want to make the service credit purchase. We make it easy for you to make the purchase in a few different ways. You have different purchase options. You can write us a lump sum check. On a post-tax basis, you can roll over money from a pre-tax retirement account, or you can do payroll deductions. We'll split it up. We'll split up the cost for you over time, and we'll take it right out of your paycheck, so that it makes it super easy for you. Or we'll do any combination of the above. Okay. Now, somebody originally asked, can you roll over money into a SARA? The only way that you could roll over money, pre-tax money, into a SARA is if you're making a service credit purchase, um, because that's the only option for doing that. If you're not making a service credit purchase and you want to roll over money into an account for your current employer, what you're going to want to be thinking about is rolling over money into a 457B account, which we're going to talk about in the second half of the presentation. So your Sarah retirement contributions, you can't, there's no way to contribute more money to get a higher retirement benefit. It doesn't work that way. You'll notice in the retirement formula, your contributions is not one of the 3 factors in the formula. We don't even take that into consideration when determining your payment. What we are doing is we are collecting enough contributions that our actuary tells us that we need to collect in order to pay all the benefits out that we owe. So that's how your contribution rate is set, and it's set for you. You don't have any control over that. So you can't put extra money into a SARA beyond rolling over money for making a service credit purchase. Okay, somebody's asking, would it be even worth it to buy my tap time, which was only like 4 months? It may be. It may be worth it. One way that you can figure out whether it's worth it is, and I do think I go through this step by step on the service credit purchase page, which I think is acera.org/purchase. But what you can do is you can use our estimator tool on our website. You log into your account on our website. You use our estimator tool and you run 2 estimates. And there's an override field in there where you can add 4 months worth of service credit. So you run one estimate, just plain. You run one estimate, adding the 4 months of service credit in. And what you're doing is you're thinking about a plausible retirement scenario, like you're gonna retire 20 years from now. So you kind of run that scenario with the one estimate without the 4 months, one estimate with the 4 months. The second estimate is going to be bigger because you have more service credit. So it's going to estimate a higher pension allowance. And all you do is you take the 2 estimates and you subtract the estimate, the smaller one from the bigger one, and you see what the difference is between the two. How much more per month will the second estimate give you if you make the service credit purchase? Okay. And then what you can do is you can get out your letter that Sarah sent you telling you what the dollar amount is that it's going to take to make the service credit purchase, and you can see how many months of higher retirement payments it will take to get your service credit purchase amount back. So you take the amount that we're telling you it's going to cost, and you just divide it by the difference between the two estimates that you did on our website. And that will tell you, like, let's say that there's $100 difference between the two estimates. Making the service credit purchase gives you another $100 in retirement allowance. And let's say that we tell you that the service credit purchase is going to be $1,200 to make the service credit purchase. Well, you can see that it's only going to take you 12 months of higher retirement payments in retirement to get all that money back that you used to make the service credit purchase. So that seems pretty worth it to me. So that's kind of how you can figure it out for yourself is, how long it takes to get the money back because you will get higher retirement allowance payments by making a service credit purchase, and it will pay off eventually. It's just whether it's worth it to you to make the service credit purchase and how soon it will pay you back the money that you spent. Next question. Is there a deadline to repurchase each time? The deadline is that you have to purchase any service credit that you want included in your retirement calculation before you retire. That's the only deadline. Now, having said that, going back to this slide, because of this interest deal here, the longer you wait to purchase service credit, the more expensive it gets. So my recommendation is purchase service credit as soon as you can, and it will be way cheaper for you to make the service credit purchase. And we do have these options for you. You can write us a check for some, you can roll over some money, or we'll split it up for you through payroll deductions or any combination. And somebody says, what if you have a break in service for one pay period? I don't actually know what that means, a break in service for one pay period. My guess is that that's not purchasable because it's not one of the it's not one of the items on this list. But the real answer is that for anything I don't know, what you should do is contact my colleagues. You go to acera.org/contact, and I'll type it in here for you. And there is an email contact form on the webpage, and you can ask that question. And or you could call us. We have a call center. Their only job is to answer your questions. And so you can find the number on that contact page as well. Next question. Let's see here. Okay, so the question is, I'm new to the public sector. With the 401k, I choose my investment allocations. With the SARA, do I have that option? Also, are the contribution amounts fixed? What percentage do both the employer and employee contribute? Is there an equivalent to the match we have in a 401k? Okay, so you do not have control over what your contributions are because, as I was saying earlier, the way we set contributions is by our actuary telling us how much money we need to collect from the employee and the employer in order to pay out all the benefits that we owe now and in the future. So you can't change your contribution rate. You can see what your contribution rate is if you go to acera.org/contributions. And you scroll down here, these are the average contribution rates, but if you dig in farther, you look for your tier here, like let's say you said you're new, so it's possible that you are the general tier 4 tab is totally missing here. That is definitely a mistake. So I will fix that later on today, and I'll put that back in. I'm not sure how that got deleted. So if you are tier 4, later on, you can go in and check that out. Is it? Oh no, here it is. It's at the bottom, and I think this heading is. Uh, I just need to fix the code on the heading, and it'll pop back in there. So this would be everyone in tier 4 pays a flat contribution rate. If you're not in tier 4, it's based on your age of entry into Acera, and you can check out what your contribution rate is on this page. Now, to answer your question, now, yeah, if you're general tier 4, it's 9.06% for this year is your contribution rate, 9.06% of your pay. Now, to answer your question regarding investment allocations, you have no control over what we invest in. We have an investment department and investment consultants, and our board of retirement handles all the investments. They invest everything on a group basis. If you want to see what we invest in, you can go to acera.org/investments and check out our investments page. You can look at our current investment portfolio, but you have no control over this. We are a $12 billion fund, and we invest everything on a group basis in order to collect, earn enough money so that we can pay out the benefits that we owe. Now, what you're probably thinking of, since you're from the private sector, is like regarding a 401k and your allocations. You can do that when you save extra money in your 457B. So you are fortunate in that you're not only going to get to collect a pension in the future, but you can save additional toward retirement in a 457B plan, and you can choose your investment allocations within that. We're going to go take a deep dive into that at the last topic in this presentation. So we will get there. There is no match for a Sarah for the 457B because your employer is contributing to a Sarah. And so they're contributing to your pension rather than matching anything in the 457B. Okay, so you're saying the next question, I've been purchasing 1 week each year for the last 3 years. I'm 74, 6 years of service, tier four. How much does that affect my retirement at the end of next year? Okay, yeah, and you're purchasing 1 week of vacation. Um, so let's see here. Well, it's probably going to decrease your retirement that you would have gotten by 1/52nd, which is, let's multiply that by 100. So about 1.9%. So it's probably going to be your retirement allowance is going to be 1.9% less than it would have been had you not made those 1 week purchases each of the last 3 years. Having said that, 1.9% is not huge, and you could tack on 3 additional weeks on the end of your career and it would make up for it. So, um, that's kind of an easy way to get that back, get that time back is to just tack on 3 weeks at the end. And that's just kind of a ballpark of how that would affect your ACERA retirement allowance. One thing that you could do is run an estimate in our benefit estimator. Do one normal and do one where you're adding 3 weeks, so 3/52nds of a year to your service credit, and see what the increase would be to work that additional 3 weeks. And you're asking, how do I do this? Well, to add 3 weeks to the end of your career, you would just choose a retirement date that's 3 weeks later than you were planning to retire, because you're going to choose your retirement date. Okay, so we talked a lot about the age factor percentage. We talked a lot about the service credit. Let me tell you how we calculate the highest average monthly salary. Oh, you're welcome. Let me see, there's a beneficiary question popped up. Yeah, I'll get to that one. Somebody's asking about purchasing service credit and how it affects vesting. You'll note if you look at the list, all of these types of purchases count toward vesting in retirement and retirement eligibility. This one does not. Okay. And then somebody's saying, is there a way to find out how many weeks of vacation I purchased in the past? If you run the benefit estimate, you use the benefit estimator in your account on our website, and you yeah, actually I think probably the best way to do that is to go to your payroll clerk. I was gonna say it'll show up in the benefit estimator, but if you're running an estimate for many um for a while from now, it's not going to show up in there. So never mind about that. Yeah, I would go check with your payroll clerk to see if they could pull those records. Okay, we talked a lot about the age factor percentage, how we calculate the years of service credit. How do we calculate the average monthly salary? So our software, when you go to retire, is going to look through all your payroll records that we have on file for you because your employer transmits those to us so we can do these calculations, and it's going to find your period of highest pay anywhere in your career, period of highest consecutive pay. In our pension lingo, this is known as your final compensation period. If you're in tiers 1 and 3, your final compensation period is your highest consecutive 26 biweekly or 12 monthly pay periods, depending on how you're paid. If you're in tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods, depending on how you're paid. Essentially, in tiers 1 and 3, it's your highest year of pay. In tiers 2 and 4, it's your highest 3 years of pay. And our goal for the calculation is to find your highest average monthly salary. So what our software will do is take your total pay during this highest year or highest 3 years, and it will take an average of your pay over that time by simply dividing by the number of months in that period. And that gets the average salary over that highest 3 years or highest 1 year. And this is the number that we plug into the retirement formula for you. So that's how we determine your highest average monthly salary. Now, it's gross pay that is used in the calculation before any deductions are taken out. And there's four types of pay, four broad categories that will be included in your highest average salary calculation. Your base pay, of course, that one makes sense. Now, there's other pay codes that could be included. And I can't tell you which other pay codes are included or are not included because there's like 1,000 of them. But you can find out for yourself by going to acera.org/pay codes, opening up the list for your employer, find your pay code. It'll say yes or no whether it's included in this calculation or not and counts toward pay for calculating your retirement. The only one that I know that never counts is overtime. Now, there's two more types of possible pay that can go into your highest average salary calculation. Only if you're in tiers 1 and 2. Tiers 3 and 4, it is disallowed from that. So if you're in tiers 1 and 2, if you sell vacation during that final compensation period, or if your final compensation period is at the end of your career because you're making your highest rate of pay at the end of your career, um, and you cash out, your employer will cash you out for any vacation that's still on the books that you haven't used yet, and that cash can increase your salary. I'm not going to take a deep dive into that topic. If you want more info on that, you can visit acera.org/vacation. Uh, but actually, the best deep dive, if you're curious about that topic, is to go out to our website, um, scroll down to the pre-retirement webinar, which is what we give to people who are within 3 years of retirement. Fast forward through it until you get to the same slide that I'm on, which is this one. And then I talk about that topic at length for probably 15 minutes. And somebody's asking, your gross pay would be calculated before any payments are made to the 457B program. Yep, before any deductions are taken out. There's one limit to your benefit payments that I really want to point out here. There's a few limits. If you go to acera.org/limits that you can peruse, there's a couple for people who have super high salaries. There's one that says that you can't make your retirement allowance can't be more than 100% of your highest average monthly salary, which is actually pretty hard to hit. So most people don't hit that limit. The one that is more common is for the tier 4 people. When the state of California created tier 4 in the Public Employee Pension Reform Act, PEPRA, in 2012, that took effect January 1st, 2013, they included this additional rule, which is that the amount of your salary that Acera is allowed to use to calculate your retirement allowance is capped at a maximum amount of annual dollars that we're allowed to include in that calculation. And the cap goes up every year. It's based on the Social Security wage index limit. So that it increases every year. So by the time you all retire, it's going to be much higher than this. But the cap for 2025 is 155,081 for general members and 186,096 for safety members. So if you do have a higher salary than that, the way it works is that we cannot use any more annual dollars than whatever the cap is when we're going to calculate your retirement in order to calculate your highest average salary. So it will decrease the salary that we use in the formula for you. But what it does do is while you're working, when you hit the cap, like let's say that you had a higher salary than let's say it was you had a $200,000 salary as a general member. Well, probably about three-quarters of the way through the year, you're going to hit the cap. And then for the last 3 months of the year, Acera will actually stop taking out employee contributions out of your paycheck until January 1st, and then your contributions will kick back in. So the last 3 months of the year, that would give you more money to save in your 457B account or other savings. And then somebody's asking, you got to leave early, so will this be accessible later? We're going to have a recording of this up on our website within about a week, but there's already a recording of a previous one, and they're all pretty much the same. If you go to acera.org, scroll down to the bottom, click here, new employee mid-career webinar, um, it will, pop right up, and you can pick up where you left off. Additionally, if you want to see the slides, go under news and events, go down to retirement planning seminars, or you can just type in acera.org/seminars, open up this Paycheck for Life, new and employee mid-career employee webinar. Here's the handout, and this is a PDF of all the slides. And thanks for being here when you could be here. Oh, also, one more thing I want to point out about that is we do have more sessions later in the year that you can register for. The next one is August 12th, August 12th and August 15th. So you could register for another live session then. You're welcome. Sarah.org/seminars. Okay, yep, I finished up that. And then here's the whole example put together of the whole formula. Now that you understand all the three factors in the formula. In this example, this tier 4 member retires at age 65 after earning 25 years exactly of service credit. Because they're a tier 4 member and they're retiring at age 65, when we go to the age factor chart, we find that those intersect at 2.30%. We plug that into the formula. They've earned 25 years of service. We plug that in. Their highest average monthly salary was $6,000 per month. So we plug that in, we multiply it all together, and their monthly retirement allowance for life is equal to $3,450. And what you can do is you can take these two factors, multiply them together, and that gives you the salary replacement percentage that they've achieved. This $3,450 is 57.5% of their $6,000 salary. And if they hit 57.5% salary replacement just from the Acera pension alone, that's pretty good. They're well on their way to that 80% salary replacement amount. So somebody's asking the hitting the cap is rare. Uh, so maybe I was probably being confusing. I don't think tier 4 members with salaries above the cap are rare per se. Like there are, a significant number of people who hit the cap. What is rare is another limit, and I'll just take you out to the limits page real fast, sarah.org/limits, so you can see them. What is rare is hitting this cap, the first limit, which is that you have earned so much credit toward retirement that your highest average monthly salary or that your projected benefit would be more than 100% of your highest average monthly salary. And at that point, that cap kicks in, and then your benefit payment is capped at 100% of your highest average monthly salary. If you hit that, you're doing really good. You got to work for 35, 40 years and retire at a certain age. And that means that you're going to make exactly how much in retirement that you were making while you were working. And you've achieved 100% salary replacement from the pension alone. And additionally, you would get, Social Security, and if you're paying into Social Security as a general member or a safety member, if you've already paid into Social Security at least 10 years in some other job, so you would be in good shape if you hit that cap of 100% of your highest average monthly salary. You are welcome. Okay, let me help you get a pension estimate. This is how. Okay, so you have what we've been talking about up to now was the nuts and bolts of the pension system. I told you how you're contributing, how your membership works, your tier. We talked about the pension formula and how to dial in each of those three numbers. And when I say dial in each of those three numbers, it's a little bit of a, it's a little bit of a loose concept because mostly the way to do it is working longer. But then you got the service credit purchase, so that can help you dial in the service credit. Regarding the salary, you would just get your raises if you have like the step raises or get promotions or get higher positions. But mostly it's like working longer. You'll see when we get to the part about saving extra toward retirement in the 457B plan, there you really have a wide latitude for dialing in that adequate income replacement. Okay. So we've talked about, all that stuff in general about how Sarah works up to now. Um, so let me help you get a precision pension benefit estimate. So you can specifically get a picture into the future of what a Sarah is planning on paying you based on the credit that you've earned in retirement, what you would receive in retirement. So you go out to Acera.org. I'm going to show you screenshots. Um, you go out to Acera.org, you click the login sign up button. You log in. Once you get in there, and like I was saying before, if you need to request a PIN, it will take you a few days to get the PIN letter in the mail, and then you can log in. You're going to click on Estimate a Benefit in the menu, and then you're going to see this screen. And it's going to ask you a couple of questions. It's going to want you to put in a separation date and a payments begin date. I'll just zoom in here so you can see it a little bit better. The separation date is your last day on payroll that you're planning on being on payroll. The payments begin date is your first day of retirement. Some of you are going to stop working and not retire immediately and defer your retirement to a later date. That's called becoming a deferred member. I'll talk about that a little bit later. And it's perfectly fine to do. Some of you are going to work straight into retirement. If you don't know what you're going to do yet, you can just kind of do just think of your plausible retirement scenario and just pick dates, based on that. And if you do want to see what happens if you work straight into retirement, you would just pick two consecutive dates. So if you think, I want to see what happens if I retire 20 years from now and we're in 2025. Well, you would pick two dates in 2045 and you plug those in here. Okay. And the payments begin date has to be at least the next day after the separation date. You can put in beneficiary info in here if you want. If you have designated your beneficiary with Acera already, you may see these fields pre-populated. And if they are pre-populated, check the date of birth. Make sure it's correct. Some of them are not correct. And if it's incorrect, it will throw off some of the calculations. I recommend leaving these three unchecked, leaving these three blank, and you'll get a nice conservative estimate. But if you want to, you can override the service credit amount here by checking the box and entering a new amount of service credit. And the way to do it is hit generate first, get the pension estimate, see how much service credit it's using, then come back and do it again with a greater service credit amount. Okay. And then you can override the salary here if you want to, because it's gonna project a salary. It's gonna give you a salary projection based on your current salary. But if you're going to retire far in the future and you're expecting a higher salary there, you could add, kind of average interest into your current salary, however many years in the future you're doing this for. It's kind of up to you. But if you leave all these blank, it'll give you a nice conservative estimate. Hit generate. You end up with this PDF retirement benefit estimate that you should download and save on your device. And what this box here, well, first of all, this is page one. This is giving you your monthly retirement estimate. Page two shows you the info, the details, the data that it's using to calculate the estimate. So just zooming in on the monthly estimated benefit from page one, you can see that it's giving you a column here, member monthly benefit, and it's estimating a monthly amount that you would get paid in retirement in your retirement scenario for different retirement allowance options you're going to be presented with at the time of retirement. I my In my experience, you don't need to really think about these options until you get close to retirement. These different options pay your beneficiaries different amounts, possible amounts, and your life might look different by the time you get to retirement. So what I like to do is just kind of go by this number. Most people pick the unmodified option anyway because it pays the highest monthly benefit. And you can just kind of go by this number for now. If you do want more info on the different retirement options and what they do, you can go to acera.org/retire and it has info on the different options. Okay. So let me help you understand on our next topic, retirement eligibility. How do you actually become eligible to retire from Acera? Because you got to meet some requirements to become eligible to retire. We're talking about this date on the pension milestone chart here. Your first day that you are eligible to retire based on some combination of your years of service and age. Now, this first slide, I'll show you the combinations that get you to retirement eligibility for tiers 1 through 3. Tier 4 is on the next slide because it's a little bit different. So if you're in tiers 1, 2, and 3, you can become eligible to retire through one of these three combinations. Option number 1 is that you're at least age 50 and you have at least 5 years of service credit and you have at least 10 years of membership with Acera. Now, having said that, tiers 1, 2, and 3 closed more than 10 years ago. So everyone in tiers 1, 2, and 3 already has 10 years of membership. You don't even have to think about it. Don't even worry about that. Just think about the age 50, 5 years of service credit, and you're eligible to retire as long as you're at least age 50 with the 5 years of service credit. Option number 2 is that if you are a general member and you have at least 30 years of service credit, or if you're a safety member and you have at least 20 years of service credit, you can retire at any age, even if it's younger than age 50 that you would need for option number 1. Option number 3 is that you can retire with any amount of service credit at age 70 or older, even if it's less than the 5 years of service credit you would need under option 1. And those are the three combinations that get you to retirement eligibility. So as soon as you hit the 5-year mark, you go from being able to retire at age 70 to being able to retire at age 50, essentially. Now for tier 4, you have two combinations that get you to retirement eligibility. As a general member, you have to be at least age 52. As a safety member, you have to be at least age 50, and you need at least 5 years of service credit. And then you can retire from Acera. So if you were age 52 as a general member and you retired at age 52 with 5 years of service credit, we would calculate your retirement based on that 5 years of service credit. And you would get a lifetime payment for us from age 52 all the way to your death, for example. Option number 2 is that you can retire at age 70 with any amount of service credit, even if it's less than the 5 years that you need under option 1. And that's how you become eligible to retire. So that one's pretty easy. That's probably the shortest topic that we have. Let me talk about these additional benefits we offer, and then we'll take a little 5-minute break. In addition to the retirement allowance, we offer other benefits, including healthcare benefits, disability, retirement, and death benefits. Now, I'll talk about the healthcare benefits and death benefits in a little more detail. The disability retirement, I don't really talk about much in this presentation. If you want more information about that, you can go to acera.org/disability. Disability retirement is kind of a different retirement from what is sometimes called the regular retirement, but is also known as service retirement. Disability retirement is where at some point in your career, you become permanently disabled and you can no longer perform your job duties. If that's true, you can apply for disability retirement through Acera and you can be awarded a disability retirement. And there are some advantages to that that you can check out on our disability retirement page. So if you ever have, if that's ever, just to let you know that exists and there's more information out there at acera.org/disability. Okay, now regarding the healthcare benefits, let me talk about those real fast. You might be wondering, I'm a new employee or I'm in the middle of my career and I'm nowhere near retirement yet. Why do I need to know about the healthcare benefits that Acera offers? Well, I'm not going to tell you the details of the healthcare benefits. I just want you to know about these subsidies that we offer. And part of it has to do with the years of Acera service credit you need to qualify for those. So I want you to know this now, and that will help you with your career planning, to be cognizant of this amount of service credit. Okay. So we offer these when you go to retire, you can, after retirement, enroll in one of our healthcare plans or medical, dental, vision plans. So we offer those. And if you have a certain amount of service credit with Acera, you will pay for part of the cost, or in the case of dental and vision, all of the cost of being enrolled in those plans. And these are extra benefits that are not vested. They're not guaranteed benefits. They're offered from this reserve fund that the county started back in the 80s so that their retirees would have more money to pay for these kind of benefits in retirement. And Sarah administers, our Board of Retirement administers this reserve fund, and their goal is to maintain the sustainability of this fund. So they will tweak these benefits from time to time just to make sure the fund stays sustainable so they can continue offering these. So that's just a caveat, just to let you know, these are not guaranteed benefits. These are extra benefits. And we actually offer a higher level of these benefits than any county in California. Okay. So the reason I'm telling you this now is to show you that there's this medical subsidy. There's three levels of it. MMA is known as it's the name of the medical subsidy. It's called monthly medical allowance. There's a dental subsidy, a vision subsidy, a Medicare subsidy, and there's also an extra supplemental cost of living adjustment on top of the vested cost of living adjustment. You'll note that it takes a certain number of years of Acera service credit to qualify for these subsidies. They start at 10 years, except for the supplemental cost of living adjustment. All of them start at 10 years. And then there's two additional levels of the medical subsidy 15 and 20 years of Acera service credit. The reason I'm telling you this now is because this represents a good chunk of additional money that you have in retirement to pay for your life. So you may want to figure this into your career planning. If you, for example, if you've been working here for 9.5 years already and you're thinking about going and doing something else with your life and getting a job somewhere else, you may want to hold out for another 6 months, get over the 10-year mark, because this half medical subsidy, the dental, vision, and Medicare subsidy represent a lot of additional money that you wouldn't get unless you hit at least the 10-year mark. And then if you hit the 15 or 20-year mark, same thing. Okay. And notice it says years of Acera service credit to qualify. So if you make a service credit purchase, that counts toward this. It does count toward this. Reciprocal service with another agency does not count toward this. Okay. And I'll talk about reciprocity in the second half of the presentation. So yeah, these are the extra benefits. And what I like to do regarding career planning is add another milestone to the pension milestone chart for the 10 years where the healthcare subsidies kick in. It's just something to be cognizant of. And that's why I'm just kind of giving you a basic explanation that these subsidies exist, because I want you to know where those markation lines are so that you don't stop working right before one and lose out on those subsidies. Okay, there's a question. I have a disabled child. If I have a disabled child after my death, will they get my retirement income regardless of their age? So there are options for leaving a lifetime continuance to a disabled child. You would be looking at options 2, 3, and 4. And I'm going to type in a web page to go to, acera.org/retire, and you can read about options 2, 3, and 4 and what you can leave regarding a lifetime continuance to your disabled child. I will talk about in just a few minutes. I will talk about death benefits should you die before retirement, and making sure that your beneficiaries and designations are in place to make sure that your beneficiaries should get that payment before retirement. I'll talk about that in just a minute. And somebody's asking, will the non-guaranteed benefits include the spouse as well, or only the employee? These subsidies are only available to you, the employee, the retired Acera member. But we do give you the opportunity to enroll your spouse or family members in the coverage. And you can read more details about the coverage if you're curious about at acera.org/guide. And that's our 32-page enrollment guide that we publish every year. And but yeah, you can enroll them. It's just the subsidies only cover the Acera member. Okay, let's talk about designating your beneficiary or beneficiaries and keeping them current as part of the discussion of Acera death benefits. So To just define this term, a beneficiary is someone who gets benefits. Your ACERA beneficiary is the person you designate on our forms to get your ACERA death benefits. Okay. So what I'm going to tell you about are the different scenarios should you die before retirement. These are the death benefit options available to your beneficiary should you die before retirement. Once you retire, there's a different set of death benefit options available to your beneficiaries that are similar but a little bit different. And so I talk about those in the pre-retirement webinar if you want to find that on our website. But for right now, I'm going to tell you about the death benefits available to your beneficiaries should you die before retirement. Okay. So if you are not yet vested with a SARA, which means you don't yet have the 5 years of service credit or the equivalent of 5 full-time years of service credit, and you die before retirement, your beneficiary would receive a return of your employee contributions and interest plus 1 month of salary for each year of service up to 6 months worth of your salary. So, for example, if you've already been working here for 4 years, they would get a return of the contribution account plus 4 months worth of your salary. And that's what they would get in one lump sum payment. And it could be to multiple beneficiaries if you have multiple beneficiaries designated on the beneficiary designation form. Okay, now fast forward in time. Now you're vested with ACERA. You have at least 5 years of ACERA service credit, or you have reciprocity, which I will talk about in a few minutes, and you've linked the retirement systems together and you have at least 5 years combined among the linked systems. You're considered vested in all the systems. If you're vested and you die before retirement, your beneficiaries would get a choice. So you don't choose this for them ahead of time, but they would get a choice that we would offer to them. Option number one is the exact same as the previous slide. It's a return of the employee contribution account plus 1 month of salary for each year of service, up to 6 months worth of salary. But they also would have options two and three. Option two gives them a monthly survivor's allowance, and it's to qualified beneficiary only. So, spouse, state registered domestic partner, Alameda County domestic partner, or minor children. And if it's minor children, it's not a lifetime benefit. Now, don't stress out because I'm about to tell you on the next slide how to make it so that anyone can get a lifetime continuance, regardless of who they are or how old they are. So just hang on to that thought. Okay. Option number three is kind of a hybrid of options one and two. There's a lump sum payment of the 1 month of salary for each year of service and a smaller survivor's allowance, monthly survivor's allowance. Also to spouse, state registered domestic partner, Alameda County domestic partner, or minor children. Okay, now having said all that, forget about that because ACERA has ACERA's Board of Retirement created this new way of doing things, this new option, which is that you can make an advanced death benefit election, which does two things. It maximizes the monthly survivor's allowance, and it's in most cases going to be more than had you not made the advanced death benefit election. Okay, in most cases, it's going to maximize that monthly survivor's allowance to the maximum that we can pay out based on your retirement calculation. It also expands the group of people that you can name for a lifetime continuance to anyone. Any human, can't be pets, trusts, charities, or anything like that. It has to be a human with a lifespan. But you can name one or more beneficiaries for a lifetime continuance. Okay. As long as you make the advanced death benefit election, I'm going to show you on the next slide how to do that. Let me just check these questions real fast. Yeah, so somebody's asking adding beneficiaries and splitting it between two beneficiaries. This is the way to do it. Splitting it between two beneficiaries is putting both beneficiaries on your beneficiary designation form and checking the box for advanced death benefit election. So I'll show you that in just a second. And then let me see here. Next question. Somebody's asking two beneficiary. Okay, you have two beneficiaries and one passes. Do the payments then go to the second beneficiary until they pass? If you leave the county, okay. The second question I'll hang on to for later. The two beneficiaries, if you've already passed away and your beneficiaries are already receiving, let's say you name two beneficiaries for the monthly survivor's allowance for their for lifetime survivor's allowance, and one beneficiary passes away, I'm 99% sure that we don't increase the payment to the second beneficiary. But the second beneficiary would continue receiving their lifetime payment. Okay, now, so this advanced death benefit election, every active member should make the advanced death benefit election. You do it by going to our beneficiary designation form, acera.org/BEN, and checking the box for the advanced death benefit election and resubmitting the beneficiary designation form. So you go to acera.org/BEN, you save the form to your device, you complete all the fields, you check the box, print and sign the form. There's 5 different options on the last page to submit the form. If you haven't done this yet, we sent out an email to everyone last year when this became available, urging you to do it. There's no downside to it. There's no disadvantage. If you haven't done it yet, you should go ahead and do it today. If you don't remember whether you've done it, you can write into my colleagues at acera.org/contact, and I think they can tell you whether you've done it or not. You can't see, there's no checkbox in your member account yet that shows you whether you've done it or not. We haven't implemented that yet. But if you're just unsure, you can just resubmit the beneficiary designation form. In fact, you can resubmit your beneficiary designation form anytime you want, and every new beneficiary designation form supersedes any previous ones. Let me just show you what happens. If you go out to acera.org and you type in acera.org/BEN, it takes you a shortcut to this PDF. Click the download button to save it to your device, okay? And then you are going to fill out your information. You're going to name your beneficiary or beneficiaries, your primary beneficiaries. You can name more than one. There's 3 sets of fields here, and if you need more sets, you can contact us and we can tell you how to do that. There's 3 sets for contingent beneficiaries, and all you need to do is check this box. I elect the advanced death benefit election. I advance the advanced death benefit. There is no disadvantage to making this election. Your spouse needs to sign, so you need to fill out that info and have your spouse sign. And then all you do is you print it out, you sign. If you have a spouse, your spouse signs, and then there's 5 options here to submit the form. We can't do it all electronically yet because of the spouse signature, but we're still trying to figure that out. But like I said, every active member should do this. If you haven't done it yet, go ahead and do it today. And somebody's asking, would I have gotten a confirmation email? I believe we're sending out confirmation letters in the mail. I don't think we're sending out confirmation emails. There could be a backlog on those. So if you're unsure, it does not hurt to submit a new one. Oh yeah, oh man, go paperless. Absolutely. We're actually in the midst of doing that. We just relaunched our member portal, Member Direct. We relaunched that back in November, and it does have a member correspondence area, and so we're working on getting all that stuff going paperless. Eventually, we won't have any of these PDF looking forms. It's all going to be in the member portal. Okay, so that's my spiel for the advanced death benefit election. Now, if you are a deferred member, which means that you stopped working for your employer and you have not yet retired, you deferred your retirement to a later date, and you die before you are able to retire from Acera, we would just issue your beneficiaries a return of the employee contributions and interest. That would be the sole option that they would have. And a question just popped up. So is there a way to get your adult child a lifetime benefit on your death? Absolutely. So you make the advanced death benefit election. So all you do is you fill out the beneficiary designation form, make the election, and it makes it so that you can name any beneficiary. So all you need to do is put your adult child on there as your beneficiary, check the box, resubmit the form, and they will have been designated for a lifetime benefit upon your death before retirement. Yep, absolutely. If they're a minor and become an adult, they still get it. Absolutely. Yeah, I mean, we don't care what their age is uh, regarding that. There is a on the form, you'll note there are some instructions if they're a minor on next to the beneficiary designation fields. If you're naming a minor, go ahead and click the link and it gives you instructions on how to fill this out because you can name an adult custodian for the minor until they achieve adult age. Well, there are different options. You're saying if it only works before retirement, there are options to do that after retirement too. It's just that we don't cover that in this webinar. But if you want more info on that, you can check out our pre-retirement webinar. We do have recordings of that up on our website. And then somebody's asking, do you do living trusts here too? Well, you can name a charity, trust, or an estate as your beneficiary, but not for a continuance. So if you are naming a trust, um, they will not get a continuing lifetime payment. They will only get a lump sum payment. They will only have the lump sum option. You're welcome. But there are instructions on the form to name a charity, trust, or estate. Okay, last thing about death benefits is keep your beneficiary designations current. If you want more info on the death benefits, acera.org/death. If you do want info on the death benefits after retirement, there's info about those there also. Keep your beneficiary designations current. Log into your account from time to time. See what our pension data is in there for you. Make sure it's all correct. Click on the beneficiaries tab. See who you've designated for your beneficiaries. If you see your spouse from 3 spouses ago up there, you're probably going to want to go ahead and redesignate your beneficiary because you don't want us to pay the wrong person after your death. And we pay whoever you've designated with us on our forms. Doesn't matter who you've designated anywhere else, your will, any other beneficiary designations for any other accounts, doesn't matter. You designate your beneficiaries for Acera on our beneficiary designation form, and that takes precedence over everything. Okay, let me talk about some career planning options. What I mean by this is that at some point in the future, you're going to stop working here and you're going to want to do something with your Acera membership. You're either going to want to collect your Acera retirement or you have some other options, okay? Now, I've kind of divided this into two broad options, options 1 and 2. And then option 2, there's going to be 3 sub options. Okay. So the first broad option regarding you being done working in your job here is if you're eligible to retire from Acera at the time that you stop working here, you can just go ahead and retire and draw your lifetime pension. Okay. So you're going to earn service credit right up to retirement. In that case, where we'll actually convert your half of your sick leave to service credit up to a cap. Um, you can go work somewhere else if you want. We don't care. We're going to consider you an Acera retiree, pay you your lifetime benefit every month for the rest of your life, and you can go work wherever you want. So that's one option. Option number 1, retire from Acera. Now, option number 2 is that it's kind of the broad category is here is that you're not going to you're going to stop working, but you're not going to retire from Acera immediately. And then you have 3 sub options under that heading. Okay. Your first sub option is to become a deferred member. And what I'm going to do here is on the pension milestone chart, I'm going to separate these 2 dates now. And I'm going to move the termination date earlier, so that there's a separation date because you're going to stop working and not retire yet. You're going to do something else. You're going to do one of these 3 options. Option A, I'll do options A, B, and C. Option A is to become an Acera deferred member, which means that you stopped working and you're deferring your retirement to a later date or deferring your decision to a later date, which means you're leaving your contributions on deposit with Acera. That's the main thing that you do. You leave your contributions on deposit with Acera. You don't take a refund, which is going to be option C, and that automatically makes you a deferred member. You're still an Acera member. Deferred member, the word member is in there. You're an Acera member. We will continue to post interest to your employee contribution account. We will post no negative interest, and that's a made up term that I made up, but what I mean by that is that Your balance of your contribution account never declines. It doesn't matter what happens to our investments in the short term. If we have negative, if we have a negative return in a 6 month period, we don't take any money out of your account. It's absolutely risk free. Your balance never declines. We only post interest when we earn it to your account. It's kind of amazing with the amounts of interest that we earn, and you can see what we've earned historically. And the caveat here is that the past doesn't necessarily dictate the future. But if you go and I already showed you this sarah.org/interest, you can see how much we tend to earn per year. There's a year column, so you can compare it with other financial instruments, and it's a pretty good amount of interest that we earn, that we have historically earned per year, that we've posted to your accounts with zero risk. So it's kind of amazing. You can also retire later out of deferred status. So you can stop working now and then retire later. You don't have to go straight into retirement. You can retire later as a deferred member. Or you could come back to work and earn more. So you could become a deferred member, and then later you want to come back to work and earn more money toward retirement, or I mean, earn more credit toward retirement. You can do that, and you'll become an active member again and start paying contributions again and start earning more service credit. As a deferred member, if you decide not to retire later, you could be refunded at any time, which is going to be option C. So if you stop working here and you don't know what you want to do yet, you don't have to decide right now. You can become a deferred member. We'll continue posting interest to your account every 6 months that we earn interest, and you could be refunded later if you wanted to. And there's more information at acera.org/defer. There are some good reasons to become a deferred member. There are some not so good reasons to become a deferred member. And you can check those out on that page, along with some other info that you're probably going to want to know. Okay, option B. You stop working here. You can, but you're not going to retire yet. You can establish reciprocity with another retirement system in California. This is the linking of multiple California public retirement systems together to synergize the benefits between them. We have reciprocity. We have reciprocal agreements where we do this synergy with many California cities, any county in California, all California state jobs except for UC system, um, any agency that uses CalPERS for their retirement, because there's some agencies that aren't state jobs, but they still use CalPERS to provide retirement benefits to their employees. Any of those agencies we have reciprocity with. You can see the full list at acera.org. And if you link the systems together, you get benefits. There's a synergy, like I was saying, that is created among the systems. One of the benefits is that the service credit you earn in all systems linked together gets you over the vesting and retirement eligibility requirements. The second is that the highest average salary you earn under any reciprocal system is used by all the systems when they calculate your retirement, because we're each going to do a separate retirement calculation based on the service credit that you earn in each system and your age factor percentage in each system. But all of the systems linked together are going to use your highest salary earned under any system. So if you were at a previous job where you were earning less money in a different pension system, and then you come over here to Acera and you're earning more money, when they go to calculate your retirement, when you retire from them, when you retire from all the systems on the same day, when they calculate your retirement, they're going to use the highest salary that you were earning over here, which means that you're going to get more money from that pension system than you would have had you not come over here to get that higher position. So that is one of the levers that you can use to dial in the salary component of your calculation, is to jump systems, get a higher paying job in a reciprocal system. I mean, another way to do it is to get a higher paying job within the same system, within Acera. Another benefit is that if you enter in an earlier tier, it could keep your contribution rate lower than it would have been had you entered in a tier 4, and it could put you in an earlier tier. So this is sometimes a benefit of reciprocity. In order to qualify for reciprocity, you got to do 4 things. You got to leave your contributions on deposit and become a deferred member with every system you're linking together. You can link together multiple systems, 4, 5, 6 different systems, as long as no more than 6 months passes between when you stop one job and you enter the next and you start employment at the next job. So if you enter the next system within 6 months, you can link them together with reciprocity. You also don't want to have more than 12 weeks of overlapping service. Um, you really don't want to have any overlapping service. So this is where you go on vacation leave on one job and you immediately start another job and you're in active status in two jobs at once. Just don't do that. Don't have any overlapping service. They're going to cash you out for your unused vacation anyway at the first job. So yeah, just make a clean break, start the next job, and then you got to retire from all the systems on the same day. Okay, so you're giving the example. There's somebody's giving the example. CalPER, you worked for a CalPERS agency. You came over here. You worked only there for 2 years. You came over here, um, and then you work for some amount of time over for a Sarah. How does that affect vesting? Well, the combination, that's the first benefit, is the service credit. The combination of service credit between linked systems gets you over the vesting and retirement eligibility requirements. So if you worked over for CalPERS for 2 years, and then you come over to a Sarah and work for 3 years, and let's say you're tier four and you're at least age 52, between the two, you're eligible to retire. But separately, if you didn't link them together, you wouldn't have the 5 years in either system. But linked together, you all of a sudden have 5 years and you're considered vested with the 5 years among both systems. And then somebody's asking, can you explain a bit more about how the account balance remains stable? For example, with a 401k, the balance can fluctuate depending on market performance. The reason is because we we it's just the way this uh ACERA is governed. It's just the way the state law tells us how to govern ACERA. We don't take money out of your account. And as far as I know, we're not like on a conceptual basis, we are not thinking of your employee contribution account as being invested in this like in in the different diverse array of things that we invest in the same way that you would if you looked at your 401k or your 457b. I like the accounting is such that you have your employee contribution account. That's the amount of money. I mean, the money is invested in the market, but when we earn money, we post investment. And from an accounting perspective, we just don't take money out of your account. It only goes up. So, it's just kind of how it works. Um, let's see here. And somebody's asking, so the deferred or retired status freezes you out of negative market impacts. Yes. So being deferred, as I was just saying, um, we don't take any money out of your account if there are, short-term losses in the market in our investments. So your balance stays stable and only increases when we post interest to it. From the perspective of somebody who is interested in the balance of your account, which would be somebody who might be taking option C here, eventually taking a refund. If you're not going to take a refund, if you're going to retire from a Sarah, the balance of your account really doesn't matter because you'll note that the balance of your contribution account is not one of the three factors in the retirement formula. So if you are going to retire from a Sarah and draw the lifetime pension, you really don't have to worry about the balance of your account. What you want to focus on is the um, the uh, the benefit, the estimated benefit that we're gonna pay you on a monthly basis. And on the back end, we handle the investments. We handle making sure the fund is completely funded so that we have the money to pay out all the benefits that we owe now and in the future. And in fact, by law, the employer is on the hook for any shortages. And so they have to increase their employer contributions if there are investment shortages. Okay, so option C regarding when you stop working here. Yeah, it is pretty great. Option C, when you stop working here, is that you can take a refund of your contribution account if you so choose. Okay. Um, so this is your option. if you do that, we're going to issue you a lump sum payment. Okay, so it's all in one payment. And if we do that, or actually, this is one option. To if you want a lump sum payment, you're probably going to lose a third of your money immediately because we're going to withhold taxes because you're going to owe income taxes on that disbursement because you didn't pay taxes on your contributions going in. And also, if you're younger than I think 59 and a half, you'll owe penalties for early withdrawal from a retirement account, and it adds up to about a third of your money. Now, to avoid that, you would want to roll over your money into a pre-tax retirement account, and here are the options for that, and we will help you do that. Refunds take at least 45 days, if not 60 or more days. It's a slow process, so it's not instantaneous. And basically what you're saying is cancel my Acera membership. I don't want to, I don't want access. I don't want to receive the lifetime pension payment. I don't want access to any of the healthcare benefits or any of the death benefits. I just want to take my money and do what I want with it. And that's totally fine. That's totally your right. And that's why it's option C. Okay. And it's a refund of the employee contributions and interest. Now, somebody had asked, can you withdraw the employer contributions? You never can. They always stay with the fund unless you retire from Acera and draw the lifetime pension. That's the only way that you can access the employer contributions. Okay. So let me just make a little pitch for not taking a refund, especially if if you're already vested, if you already have the 5 years of service credit and you just are waiting for the age and you stop working here, you can take a refund, yes. But I don't know if you remember, one of the first slides I showed you was the fact that when you retire from Acera and draw the lifetime pension, we're already going to refund your employee contributions and interest through monthly payments within the first 3 to 5 retired years. And everything after that, it's almost like this amazing bonus that you get, but it's just how a defined benefit pension plan works. Because it's the goal is to provide stable income throughout your retirement. So it's I think if you sit down to do the math, you will find that you will make way more money over the course of your life if you take the pension payments than if you were to take a refund. Like if you're already eligible to retire, if you've gotten past the 5 years, you're already eligible to retire and you're just waiting for the age. I think if you try to take this money and do something with it to earn the amount of money that you would make over your lifetime through those guaranteed pension payments, I would be hard pressed to find an example of you being able to do that. I mean, but if that's what you want to do, you can do that. But just run the numbers yourself and see if it's possible. And the other part of it is that if you are drawing the lifetime pension, it's risk free, versus if you're trying to take money out and invest it somewhere in the market, then that you're you're exposing that money to the risks of the market. So that's the answer to that. Now, if you leave without the 5 years, um, your option would be to wait till age 70 and draw a lifetime pension. And it still could be advantageous for you to do that. And that pension payment would probably pay for a lot of your bills in retirement with the amount of, the few years that you have that we're calculating. But, that would be a time where you may think about withdrawing the funds. A lot of people will come back to work here and then they'll end up having to redeposit and pay the interest. So, like I was saying, if you leave your money on deposit here with the if you don't have the 5 years, you leave your money on deposit here with the idea that you're going to take a withdrawal in the future. If you look at how much we have earned historically, because we're a $12 billion fund where we can access a lot of investments that other people are not privy to, we do, make a solid return, or we have historically anyway. So, it's just something to consider. Okay, let's see. A couple of questions popped up. Why is it that some employers match the employee contributions, but Alameda County does not? Um, Alameda County does contribute to the system. I don't know. Think back to it's probably the second slide I showed you. You contribute through your employee contribution with every paycheck, and your employer is contributing on your behalf to Acera, and we invest all that money. And in fact, your employer because they're actually because we're not fully funded, and so they're making up for that over time. They're usually paying about double currently your contribution rate, so they're paying a lot of money into the system for you. Yeah, somebody said Alameda County contributes a great amount. We do. You can look on if you go to acera.org/contributions. There's a link to the employer contribution page, and you can see how much they're contributing on your behalf. And then somebody's asking, when you start getting your normal option A pension check, do you pay income tax on that if you're keeping it liquid for use, not reinvested? Um, okay, so I think what you're meaning is that if when you start getting your option one, this one, work straight into retirement and retire pension check, you do owe income taxes on that. So that is a disbursement. That is a taxable event. So you will owe income taxes, and then you can basically take what money you want to. You can take your pension payment and pretty much do whatever you want with it. You can reinvest it in whatever you like. Oh yeah, and somebody's pointing out that your employer contribution also shows up on your pay stub as well, so you can look there for it. Somebody's asking if I work for the county for 10 years and then leave for another employer. Once I reach retirement age, can I roll over my Acera contributions into another retirement account like an IRA or 401k, or am I only eligible for a pension benefit? I mean, that's the case where you can do that. I mean, you can any amount of time. You work here for 2 weeks and pay into the system. For 2 weeks worth, you can take a refund under option C of that money. Like, so you work here for 10 years, you could take a refund at some point in the future. Um, but if you've already put in 10 years, I think when you sit down, like go log into your account in Acera, do a pension estimate with that 10 years, and if you look at how much you would make over your lifetime versus how much you would be able to withdraw from the system, I think you'll find that on average, what you would make over your lifetime is loads more than what you would withdraw if you did a withdrawal. But of course, it's up to you. Oh yeah, thanks for being here, and yeah, check out the video when we post it for the rest. Yeah, and then somebody's asking where exactly do you see the employer contribution in your pay stub? Yeah, I'm not. It's probably under the employer benefits, and the different employers might be different as well. Um, but yeah, let me go ahead and move to the next section because I want to make sure to get to this before I turn it over to our 457B expert. Um, okay, so we've reached the pinnacle topic of this webinar, which is making a retirement planning picture. Okay, so you understand how Acera works. Now, how does it figure into this equation? And somebody was asking about, the income replacement from Acera alone versus the 80%. Now, yes, if you look at our charts out on our website, you can see different scenarios for different percentages of income replacement. That is the income replacement that you would be achieving in this row here for a Sarah monthly pension. What you want to have happen is through all the different types of retirement income, you want to get over 80% income replacement. Okay. And so what we're going to do now is we're going to look at how do you figure that out? How do you figure out now, while you still have time, while your retirement is way in the future, how do you figure out if you need to save an additional, if the pension and the Social Security is going to get you up to 80%, or if you need to save an additional money, and if you do, how much and where to save it? Okay. And it's actually not that complicated. We're going to use technology to get estimates of all three of these. So first off, your first thing that you want to do is get estimates of the first two. Okay. So you use the Acera estimator and you use the Social Security estimator. So the Acera estimator again is you go out to acera.org, click login, log into your account, go to estimate a benefit. Think of a plausible retirement scenario, generate an estimate, save this to your device. I'm going to do an example scenario for what would happen if a fictional member retires at age 62. Okay. So what I'm going to do is imagine that I have gone out and I've gotten this Acera estimate for what happens if I retire at age 62. So I save this to my device. I'm looking at the unmodified option here, that number. And I can write that on scratch paper, or I can just, have that number available, have that PDF available. Because what I'm going to do is I'm going to go use a retirement calculator and plug in these numbers. Okay. Then I'm going to go out to the Social Security website, ssa.gov/estimator. I'm going to get an estimate from their website based on logging into my personal account over at Social Security and them giving me a personal precision retirement estimate based on their system. And it's going to look something kind of like this, okay? It's gonna give you some different ages where you could start collecting Social Security payments. The longer you wait to collect them, the more you can collect. But I'm gonna look at this earliest retirement that I can collect from Social Security at age 62, and I'm gonna go by that, okay? So when I did the Acera estimate, I got about $2,200. The Social Security estimate, I got about $1,700 for age 62, okay? So when you do this, I mean, you can do different scenarios. What happens if I retire at 65? What happens if I retire at 64, 63? What happens if I retire at 58? And then you can see what the gap is regarding how much additional you can save and whether you can close that gap now. Okay. Now, what I'm going to do now that I have the Acera pension estimate and I have the Social Security estimate is I'm going to use I'm going to use a retirement calculator that is going to estimate it's going to first off tell me if I'm going to have enough to pay for my life in retirement, and if not, how much additional I'm going to need to save. There's a bunch of different ones you can use. You can Google retirement calculator. We do have links to some on our website, and I'll show you that page in a few minutes where we put the links. Um, but these are free calculators that investment companies will put out there with the idea that you use the calculator and then you sign up for like a Vanguard account. But you don't have to do that. You can just use their calculator for free. This one right here, the Empower Retirement Calculator, this one is probably the best one to use. And that one you get to when you log into your account in Empower because you have opened a 457B account. And I'm going to my colleague Gene Hilliard from the county is going to come in and talk about opening a 457B account in a few minutes. So what I'm going to do is show you the Vanguard calculator because you don't need to log in for that and just show you how this works. Okay. So the idea here is my entire goal is to figure out on my trajectory, on my retirement trajectory, knowing now what my pension estimate is and what my Social Security estimate is, will I have to save more money toward retirement? And if so, how much? Okay. So what you're seeing here is a screenshot of the Vanguard calculator. I'm going to just go and do it live so you can just get an example. So you can either type in acera.org/planning or you can go to members, go down to planning your future retirement income. And then this is actually a step-by-step process. So when we're done with this webinar and you want to go do this for yourself, these are the steps to do it. So it's all written out for you. So it helps you get the Acera estimate. It helps you get the Social Security estimate. So there's a link out to the Social Security estimator, more information about when you can collect Social Security. And then there's links to the various free calculators out there. And there's also a link to the Empower Retirement account for the 457B plan. Okay, so I'm going to show you the Vanguard calculator, just free to use. Let's say that this fictional member is 30, and what happened? They want to see what happens if they retire at age 62. Okay, which is a little bit earlier than a lot of people will retire. They'll wait till like 65 when they're Medicare eligible. The reason I'm choosing 62 for this example is kind of easy because you can immediately start collecting Social Security. If you want to look at earlier retirement scenarios, you just have to take into account that you won't be able to collect Social Security until age 62. Okay, let's say that this person makes $70,000 a year in salary. Okay, So it's asking you a bunch of questions about your retirement scenario. And right here it's asking how many annual dollars do you already save for retirement? So you can punch that in here. Let's say it's zero. Let's say you don't save any money toward retirement at all at this point. That's totally fine. Maybe, you know, maybe we'll see if you need to save additional money through using the calculator. Then it's going to ask you how much you've already saved for retirement. So if you have some retirement savings already, you can plug that in here. Let's say it's zero. Let's leave it at zero. I don't have any retirement savings so far. I'm starting out this is a brand new concept for me. Totally fine. This is where it's going to ask you what level of income replacement you want to put in. I recommend putting in at least 80% income replacement. So this is meaning, again, that you're replacing your working income with at least 80% of what it was through retirement income. When I turn it over to Gene Hilliard, he's going to try to get you pointed in a trajectory of 100% income replacement. So you could plug that in here as well and see what happens. Now, this expected annual return, it's a little bit of a loose idea. Historically, if you look at markets, you can kind of see what percentage they make. Sarah expects that we're going to make 7% per year on our investments, which is actually somewhat conservative of an annual return. So it all depends on where you are thinking about parking your money. If you're going to park your money somewhere, your additional savings somewhere that is extremely low risk, you might think about putting it more toward 2%. But if you're parking your money somewhere that is in a diverse array of investments, and if you do open a 457B account, you'll see that you can like really diversify in there. And on saving up over a long career, over long periods of time, I think 7% is a fairly comfortable number to put in here. So I think it probably should be 2 or 7, somewhere between 2 and 7%. You could, push it a little bit, but I think that's a good, ballpark to shoot for. This is where you put in your estimated income from the estimates that you got. So I'm going to put in 1,700 from Social Security, and I think it was 2,200 from a Sarah, roughly. You can put it in exactly, like you get your precision estimates, put in the precise number. Now, what it's showing you here, once you hit submit, is the gray represents what this particular calculator thinks that you're going to need in income when you retire to achieve that 80%, to maintain your standard of living, to achieve that 80% income replacement. This set of bars here is telling you how much it thinks you're going to have based on the numbers that you plugged in. And what it's saying is that because this is not as high as this bar, there's a gap here. You may have this amount of money, which is not how much you will need to maintain your standard of living. So in this case, if this bar is less than this, then it's saying that you would need to start saving additional money now in order to get pointed at that 80% income replacement trajectory. Okay, so now we've established, now we know, okay, I do need to save a little additional money. Now the question becomes, how much additional money do I need to save? So you can use the calculator to figure this out. So what I'm going to do is edit results, and I'm going to just plug in, I'm just going to try some stuff here. What happens if I save $500 annually? I'm going to hit calculate. Okay, well, the bar has moved up a little here. It's added this dark green, which represents income from that retirement savings, but it's not quite getting me there yet. So I'm gonna like overshoot it, I think. What happens if I save $7,000 per year, which would represent 10% of my income? Okay, so I don't quite need to save that much. 5,000, 7% of my annual income. Okay, getting close. I can reduce it a little bit more. Let's try 4,500. Okay, keep going on down. Whoa, 4,000. Okay, so it's pretty similar now, but you kind of get the idea. And this is saying is that in this scenario, if I through my pension, my Social Security, and my additional savings, I will have achieved the income replacement that I'm targeting by saving an additional $4,000 of my salary per year. That might sound like a lot, but if you divide that up over 26 pay periods, $153 per pay period. Okay, so then that now that you know you have the number, you have a good ballpark of your trajectory on what number to get pointed toward, then you start looking at your paycheck and you start saying, okay, how can I save some additional money out of my paycheck toward retirement? And in this case, it's $153. So you do what you can. If you can't find $153 of room in your budget per pay period, maybe you just start somewhere. Maybe you can save $20 or maybe you can save $40. So get pointed in a direction, save a little. And then once you get used to that, come back later, do the calculator again, see what it tells you. Try to get pointed in that trajectory, save a little more. And once you get up to where it's telling you you're on the trajectory to achieve your income replacement number by the time that you have, um, by the time that you retire, what I recommend is just coming back periodically and just double checking that that's still correct. Plug in all your numbers again, come back 6 months later, come back every year, do the Sarah benefit estimate, do the Social Security estimate, use one of the retirement calculators, or try multiple of them because they might all give you a little bit different number, and just kind of readjust your savings periodically to make sure you're filling in that gap if there is one, so that between the pension, the Social Security, and the additional savings, you are pointed in the trajectory of the income replacement that you're targeting. And I think what you'll find is over the course of your life, over the course of your career, by the time you get to retirement, you will have achieved the income replacement that you're looking for. And and once you get used to how this works, then you can start running estimates for younger retirement ages and see if you can dial in your savings a little bit more to retire at a younger and younger age to leave more time after you retire to live your life. Okay, so I'm a little over on time on this, so I'll let you go through the rest of the slides on your own. There's some a little bit more information about here. The main question that I want we're going to answer now is, so if you have established that you do need to save more toward retirement in order to achieve adequate income replacement, and you figured out how much to save, now the question becomes, where do I save it? Where do I put that money? And one of the best places to do it is the 457B account. A 457B account is kind of like a 401k. 401k is for the private sector. That's how people in the private sector save additional money toward retirement. 457B is what you all have access to as government workers. And it's pretty similar. There are, I think, some better rules around the 457B. And what you're doing is you're saving additional money on a tax deferred basis, so it actually will lower your tax liability in the present right now. So at this point, I am going to turn it over to my colleague Jean Hilliard. Jean, are you there? I think you're muted, Jean.
Yes, yes, I'm here. Hey,
Okay,
Mike, how's
great.
it going? Thank you.
Pretty good, yeah. And so just a couple more things just to introduce Jean. Jean Hilliard is has been hired by Alameda County to provide education on saving additional money toward retirement in the 457B plan. Now, the 457B and deferred compensation, they're the same thing. It's the same thing. The two synonyms for the same thing. Um, and so he's here to give you that education on how to, on the nuts and bolts of like how to open a 457B plan, how to save additional money, and if you don't work for Alameda County, it's fine. If you work for one of our other five employers, totally fine. 99% of the information that you're going to hear will apply to you. Okay. So I think with that, and again, we have this expanded article that takes you step by step through the process at acera.org/planning. Okay. So, Gene, go ahead and feel free to share your presentation.
Okay, will do. Let me grab it here. Let's see. Share.
And while Gene's doing that, I just want to mention that what I was showing you with on the Vanguard calculator, once you open the 457B account and you can get in there, you can use the Empower calculator to do all that stuff for you as well. Okay, we're seeing your notes.
That's what I was waiting for. I'm like, it looks good on my end, but I bet it doesn't look good on you guys' end. How do I look now?
Okay, there we go. All
All
right,
right,
Gene,
perfect.
take it away.
All right, thanks a lot. Well, good morning, everyone. I'm Gene Hilliard, Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company here in Oakland. As Mike had mentioned, we were hired roughly 16 years ago by the county to provide retirement planning, investment advice, and education to county employees. I've been a licensed financial consultant for roughly 20 years, and I'm also a retirement counselor. And as a retirement counselor, my goal, as also Mike mentioned, is I'm looking to see if I can get you guys to 100% of salary replacement. That could be a challenge, going to take significant sacrifice, but I'd rather, hey, let's shoot for 100 and let's settle for 80 or 70 if we have to. And one of the best ways to save that additional money is in your 457B plan, which is also called deferred comp. Now, Mike mentioned earlier that it's very similar to a 401k, and it is almost identical. The only difference is that with a 457B, if by chance you leave county service and you're 50, 51, 52, you have access to your money penalty free. If you're invested pre-tax, you may pay taxes, but it's penalty free versus a 401k, IRAs, 403bs. There's a penalty attached to withdrawing money before you're 59 and a half. So I just want to make sure we were clear on that. But as I mentioned, one of the best ways to save towards retirement through the county is through the deferred compensation or the 457B program. Uh, One of the questions I always ask for the most part when I'm giving these presentations is, I ask you to kind of imagine the future that you're trying to pursue in retirement. What are you going to be doing? Are you traveling, spending time with friends and family? Are you going to be split between two homes? What's your social calendar going to look like? And one of the reasons why I ask that question is I'm trying to turn the future that you imagine into dollars, right? Some people say, I need a half a million in retirement. Well, how do you know? Or I need a million. How do you know? It's important to understand what you're going to be doing and then save towards how much that lifestyle is going to cost you. Here are some of the key topics I'm going to go through with the presentation: income, benefits of enrolling, and then also how to enroll. So let's talk about retirement income. Mike talked about financial planners saying between 70 and 90. 70 and 90 is about right. But I would encourage you, especially if you're close, to create a retirement budget. Actually detail what you're going to need in retirement. And then from there you can discern whether or not it's 70, 80, 90, or maybe even 100%. But budgeting is important, creating that retirement budget so you can actually see what dollars you're going to need. Where will your income come from? Some will come from Social Security if you paid into it. Some will come from your ACERA, obviously your ACERA. If you're in deferred comp or have other retirement plans, income's gonna come from there. If you have rental income or you have an investment portfolio that generates dividends income, you may decide you want to work during retirement, which I'm all for. The issue that I have is having to work in retirement. Working in retirement, I have no issue with because I think that's a good thing. Work part-time, keep you sharp, get you out there visiting with folks. I think is a good thing. But these are typically where that 70, 90% of your income is going to come from. Now let's talk about the benefits of the plan. Investing in deferred comp, if you're not invested currently, it's pretty easy. Money comes directly out of your paycheck. You give us a percent of your salary, you give us or a specific dollar amount, and then you're off and running. Now, I typically tell people, or most people will benefit if they were to invest 10 to 15% of their pay into deferred comp, right? That's just in my experience. That's a pretty good number. It's probably challenging to do that right out the gate, but my hope is that over time you're getting raises, et cetera, et cetera. You're increasing your contributions over time to 10% or to 15%. Okay. So you can start, as I mentioned, as little as 20 bucks. Um, or as if you're doing a percent of your salary, you can go as little as 1% of your salary. Now let's talk about some of the plan highlights. Right now, everyone can contribute 23,500. That's for pretty much everyone who, well, actually everyone. But if you're over 50, you can, or if you're under 50, that's the most you can put in here, 23,500. If you're 50 and over, you can invest an additional 7,500, bring your total to $31,000 a year. There's a new rule through the Secure Act where if you're between 60 and 63, you can invest $11,250 more than the standard maximum, bringing your total to $34,750. And in some case, some of you may benefit from investing in the or utilizing the 3-year catch up. That's where you can invest $47,000 a year. You can do that for 3 years prior to retirement. You don't have to retire, but you got 3 years to make that happen. Now, some of you who are interested may say, well, Gene, I have some money in the credit union or at my bank's not earning anything. Can I write you a check for 47 grand and put it in deferred comp? Can't do that. The best we would be able to do is you can say, Gene, I want you to invest 63% of my salary into deferred comp. That's the most you can put in is 61%. Now, when you get paid, your paycheck's going to be $100. You need money to pay your regular bills. Well, you can go to that savings account to pay your bills, and you can wait for that account to dwindle down to where you feel comfortable. Maybe it's 10 grand or 5 grand in there. And then you can come back to say, well, Gene, now I want you to put it back to 10% of my salary. Okay, so that's a way you can indirectly invest money into deferred comp. Okay. Some more highlights, vesting. Vesting is that process where, a company, government agency will make you stay with that agency for a specific period of time in order to keep the employer contribution. So there is no vesting schedule with the county. 100% of the money that you put into deferred comp is yours. Now, some people always ask me, is there a match? Well, unfortunately, there is not a match in deferred comp. However, don't feel as though you're being shortchanged because you guys are getting a pretty handsome match on the Acera side, just not on the deferred comp side. Okay. So, but nevertheless, 100% of your money is yours once you leave county service. Investments, there are roughly 15 core investments. You have the option of picking your own investments. And you know what? Now that I think about it, I think I have some slides. I may have some slides later on, but I'll talk about it briefly. There are there are 3 ways in which you can invest your money into deferred comp. You can do it yourself, so you can pick your own funds. It's 15 investments. There's a stable value fund with no risk. There's some index funds in here, socially responsible investments. And then you have your standard small cap, large cap, mid cap, international. So you can do your homework, work with your current financial advisor to create a portfolio, or you can use a system called Goal Maker, award-winning asset allocation tool where you tell us what your investor profile is, tell us the year you anticipate retiring, and then we'll do the rest. So you have the freedom to go with one of those 2 options, or you can use Fisher Investments. That's the managed account program. Pay them a little bit more. I think it's like 62.62%, and they can do everything for you. Okay. Now, there are different ways in which you can add to the account. You can invest pre-tax, you can invest Roth, and you can roll money in. Now, this is not a Roth IRA. So I just want to make sure we're clear. This is not a Roth IRA. Rules are different. This is considered a Roth 457B or a pre-tax or before tax 457B. Okay, so let's talk a little bit about those two options. So the pre-tax option, this is where you're putting money, investing money into the account. You're not paying taxes on the contributions. You will pay taxes on those contributions plus the growth when you retire or when you leave county service. Okay. Now, the plus side of investing pre-tax, as I mentioned, any growth is tax deferred. Your current income may be lowered and you may pay a lower tax rate. Okay. If you, all things being equal, you make the same amount, you decide, and you always get a tax refund with that same amount that you're making per year, and you decide you want to put some money into deferred comp pre-tax, very good chance that may increase your tax refund. Or if you're always owing the government by investing pre-tax, that could lower your tax bill. So check with your tax person on that. The pre-tax option works best if you believe you're going to be in a lower tax bracket when you retire. Makes sense. I'm going to invest now, defer paying taxes. I'm in a higher tax rate, and then I'm going to pay it later when I believe I'm going to be in a lower tax rate. But let's say hypothetically you believe that you're going to probably be in a higher tax rate when you retire. You either A, feel the government is going to raise taxes on everyone, or B, you feel that you're going to inherit significant assets at some point in retirement from your parents, or you have a spouse, domestic partner, significant other that works for a technology company with stock options that could be very lucrative in the future. So therefore, I might be in a higher tax bracket. So you would rather get the taxes out of the way today. So that's where the Roth version of deferred comp makes more sense. You pay the taxes now, you avoid having to pay the taxes later. Okay. This is a side-by-side comparison of how your paycheck or the taxation on your distributions will play out. Pre-tax paycheck contributions prior to tax withholding. And then there is the, as I mentioned, the Roth paycheck contribution. But for the most part, hey, if you're investing $100 into the pre-tax version of deferred comp, figure your paycheck's going to change by like 75 bucks. If you invest $100 in the Roth version of deferred comp, paycheck's going to change dollar for dollar. Okay. And then also just know that any disbursements pre-tax is going to be taxed as ordinary incomes. So it may be a significant tax hit versus on the Roth side, there are no taxes on on the disbursements, but you also have to keep in mind that you have to, there's certain parameters. Number one, that's where the 59 and a half comes in. So you have to be at least 59 and a half. The account's open for at least 5 years. Then any Roth contributions, the gains on the Roth, because you already paid taxes on the money going in, that's going to be tax-free to you. And I kind of was all over the place on that one, but hopefully you guys get that. If not, ask the questions at the end. The other benefit of deferred comp is that your money grows much faster in many cases. Here's an example of how your money could double or triple. So if you're investing in deferred comp and hypothetically you have a rate of return of 6% on your money, figure you're going to be able to triple your money, or I'm sorry, double your money in 12 years. In 19 years, same 6% rate of return, you can even triple your money. Now, this is an example of a dollar amount that is stationary over time and how your money could double and triple. You're going to make, in many cases, much more money than this because you're going to be adding to it consistently every paycheck. So your money could grow even faster. Now, there's no guarantees on the growth. As you know, markets go up and down, up and down. But if you go out a 20-year period, 30-year period, or even 10-year period, typically the rates of return on average are in the between 6 and 8%. Okay. All right, you're in charge in terms of how much you want to contribute or what percent of your salary. Unlike a Sarah tells you this is how much you're going to contribute, what percent of your salary, and that cannot be changed. Maybe in some cases they can, maybe Mike can speak to that, but at least from my experience, that dollar amount is pretty much set in stone. But here with deferred comp, there's a little bit more flexibility. You can start contributions, you can stop, you can increase. The only hard and fast rule is that you cannot exceed the max, whatever the max is for your age in a particular year. Okay, here's where earlier I was talking about how you can invest your money. You can use Fisher, you can use Goalmaker. That's the help me do it option, or you can do it yourself. Create your own portfolio based upon the 15 core investment options. Okay. So how do you enroll? How do you make changes to enroll? If you're not currently in the plan, all you'll need to do is go to treasurer.acgov.org. Go there, click on deferred comp, print out the form because we need a wet signature. And we'll tell you exactly where you need to send the form, but complete it. Where some people get tripped up is, do I want to do pre-tax? Do I want to do the Roth? If you don't know off the top of your head, just choose pre-tax, and then you can circle back with me to see if it makes sense. So choose pre-tax. I encourage people to use a percent of your salary, not a dollar amount. Why? Because as you get raises, if you choose to use a dollar amount, you'll need to increase that dollar amount contribution amount based upon your raise. So you have to manually go in and let someone know, hey, I got a raise, I want to increase. If you use a percent of your salary, um, it's going to automatically increase it, right? So if I'm contributing 5% of my salary and my salary goes from, 100,000 to 110, we're going to be looking at a salary when we're taking that 5%, we're looking at 110 versus 100. Okay, so I prefer people use a percent of your salary. If you do have a dollar amount in mind and you just need some help doing the math, turning that dollar amount into a percentage, let me know and I can walk you through that process. If you're currently in the plan and you want to increase or even decrease, you're going to go to the same website, treasurer.acgov.org. But instead of going to enrollment form, you're going to click on payroll modification and then just put in whatever that new dollar amount or that new percentage that you're looking to change it to. For folks that are currently in the plan, I encourage you, go to AlamedaCountyDCP.com, create a user ID and password so you can kind of view your investments. You'll need actually, you don't need a PIN, but this is kind of the process. You want to click on register and you go from there. If you're not in the plan, you cannot register for the site. So don't even try it. You need to make sure your first contribution takes place first. Then once that happens, you can then register for your account, register online so you can see the growth or see what's going on with your investment portfolio. Tons of features that you can take advantage of. So I would encourage download the Empower app. Got great tools, financial planning calculators. If you're interested, you can add in outside accounts to truly see what your net worth is. As Mike mentioned, also there's a tool that a financial a retirement planning tool that automatically can calculate based upon how much you're contributing, whether or not that's going to create a significant income replacement for you. So there's a lot of great tools that you can take advantage of it. So I would encourage you log in there. Okay. If you need some help from anyone at Empower or me, you can either go to that AlamedaCountyDCP.com or you can call the 855-969-4572 telephone number to schedule an appointment. There are 4 fantastic, if I might say so myself, advisors that are here to help you. There used to, at one point, there were 2, then there was 3, and we added another team player. So there's Mark on the far left. He's been working with the county for 30, almost 40 years probably. So he's the senior guy on the team. So he's here. I'm here. I've been here roughly 16 years. And then there's some new guys, Dan and Jose. They just came on board. because we've really been getting overwhelmed with participants wanting to sign up for deferred comp. So added a couple of new gentlemen to the team. So reach out to any one of us. If your department is interested in having us come in to conduct one-on-one meetings, we'd be more than happy to do that. Or if you just want us to conduct presentations, we're certainly available for that as well. So reach out to us, same website, AlamedaCountyDCP.com, or you can call us. We'll be more than happy to assist you with any retirement planning or anything related to financial planning. We're all licensed stockbrokers, so we can help you. We don't get paid more for that. So I would encourage you to take full advantage of it. So with that, I'd love to entertain some questions.
Amazing. Thank you so much, Gene.
My pleasure. Thanks, Mike.